We still see technicals and momentum in the driver's seat.
What I think matters most of all is the fundamentals.
Active in AI, but look across the market.
The market is optimism about global reacceleration.
I like the momentum of the market. I like where it's going.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, facing down an interventionist Washington. President Trump looking to ban big investors from buying single-family homes. At the same time, he targets defense companies for buying back too much stock. The White House is also pushing to boost defense spending by $500 billion, a 50% increase for 27.
So it's been a mind-bending 48 hours. Truly, people are trying to register the barrage of information coming from the White House. And there are a lot of questions around what can actually get through, but there are a couple of really important takeaways. Number one, this is a focus increasingly on populism and catering to poll numbers that indicate a lot of displeasure. Number two, expect an expanded fiscal deficit. We are going to see that one way or another. And number three, expect a more militarized United States. And that was clear by that latest salvo with respect to that budget.
So let's get to defense. We're seeing a big rally for some of those stocks in the pre-market. There is a carrot and there is a massive stick. There's one and the other, and I can tell you at the moment the carrot's winning because we're seeing that rally across the board.
Whiplash when it comes to these defense companies overnight. First, Trump comes out and says you cannot have massive dividends. You cannot have massive buybacks. I am capping executive pay. Something you would hear from the likes of, say, Senator Bernie Sanders or Senator Elizabeth Warren, to your point about populism. Then he comes out and says, actually, to have this dream military, we need $500 billion more. This would be the single biggest increase we have ever seen for the DOD to get. And that is why then you have this whiplash, and they're starting to look, potentially, can we get this through? But to Trump's point, the Golden Dome, the Golden Fleet, all these things he's talked about are not currently paid for in the current budget.
We've got to cover that. We've got to cover housing as well. Housing for living, not for speculation. President Xi, 10 years ago. In the last 24 hours, President Trump, people live in homes, not corporations. There are some similarities in this effort.
Yeah, some real surprises that this is coming out of the White House, and I think that Neil Dutta of RenMac will express some of that coming up in just a bit. There is a question here about whether this is just a trial balloon, as Meredith Whitney was talking about, or whether this was something that was actually sustainable. You saw that really playing out in the shares of Blackstone, considering that they are such a huge owner of single-family homes. You could see that being pulled back, especially because Steve Schwarzman is a close friend of Donald Trump's and has a lot of clout in Washington, D.C. A surprise from some people that President Trump has taken this populist approach. On the other hand, look at the polls, look at the rhetoric coming out of some of the warnings from midterm elections.
Without a doubt, politically popular. Question we've got to ask this morning, is it economically effective?
Well, to Lisa's point, Neil Dutta is going to tell you no. When it comes to also these individuals like Blackstone that are buying up these single-family homes, it's a tiny part of the market. And at the same time, it actually might make it worse for home builders to go out there and want to spend. When you talk about the politics, though, do you know who else yesterday announced plans to prevent PE firms and hedge funds from purchasing homes? Gavin Newsom in California. An individual who wants to be president and is running for sure for 2028.
If you are just tuning in, welcome to the program. Equity futures this morning pulling back. The rally stalls were down about 0.2%. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management as risk appetite takes a breather. Neil Dutta of RenMac as President Trump takes on corporate America. And Amrita Sen of Energy Aspects as the US pledges to control Venezuelan crude. We begin this hour with stocks continuing to pull back from all-time highs. Seema Shah of Principal Asset Management seeing upside ahead, writing widespread fiscal stimulus, monetary normalization, accelerating AI-driven capex and adoption are all factors that should underpin robust growth. Seema joins us now for more. Seema, they're the kind of structural, big picture stories for the next 12, 24 months or so. Let's talk about the last 12, 24 hours. Seema, we're pushing back on executive pay, on capital returns. These are things you wouldn't typically associate with the United States, certainly wouldn't typically associate them with the Republican Party. As you sit there in London and your investors think about allocating capital to the United States, does it give you pause?
Well, hi, John. I think it does to some extent. I mean, any time that you have government intervention, it typically does put off investors, obviously by varying amounts. There are some things that he said there which I think they don't necessarily add up. I mean, in terms of putting off investors from corporate housing, you almost need them there to encourage greater supply, which would be your best way of resolving affordability issues. And then even on the defense side, trying to put off the investment is hardly going to be conducive to some of the things that he's saying. the other thing about this as well is that coming into 2026, there's obviously been a lot of optimism. One of the things that's been on people's assumptions is that policy upheaval, volatility is going to be a little bit less than what we had last year. And of course, as you said, the last 48 hours suggests the exact opposite. So I think that there's some things in here which may not have immediate impact, but certainly from an investor standpoint, this is a moment of pause, and maybe 2026 is not going to be as smooth as a lot of people are anticipating.
Well, Seema, let's just reflect on the last 12 months. So earnings have been great. Payroll growth has been absolutely terrible. And investors have been OK with that because earnings have been great and the equity market's been hitting all-time highs. At the same time, consumer sentiment has been rock bottom. Now, if you're a politician, to address the consumer sentiment issues, you might have to introduce policies that aren't going to be favourable for the kind of things that have driven us to all-time highs in the equity market, the kind of things that have driven a long-term bull market in the United States. Seema, do we have to think about those issues a little bit more going into the midterms and beyond? That for a whole generation of individuals that haven't participated in this run-up in the equity market, they're voting for this stuff, and they're going to keep voting for this stuff. And it's the kind of stuff that's not going to be favourable for risk assets.
It is. I think it's some of those pockets. So it's a question of how much does that impact the aggregate. So, as you said, to your point, affordability is going to be the buzzword. It has been for the last month or two. It's likely to continue. How could we see that playing out? Well, there's obviously the couple of policies around a tariff dividend. There's also the idea about maybe potentially lowering some of the tariffs that are impacting some of the lower income households the most. Now, those things, ideally, if we think that through, if that can get passed, and that would suggest that you could see some upside for consumer discretionary. But ultimately, because of the K-shape, but mainly because the top 10% really do account for around half of US consumer spending, it doesn't necessarily move the needle. What we want to see is a constructive economic backdrop where earnings can continue to do well. And it's important that those policies, and at the moment it doesn't look like it will be, but as long as those policies are not going to be impacting the earnings growth for a lot of these companies that we're focusing on.
This is the reason why, Seema, so many people have looked past some of the volatility and at least headlines coming from Washington, D.C. There is one aspect, though, that has remained relatively unnoticed, at least with respect to bond markets, and that is you can expect an expansion of the fiscal deficit possibly quite considerably, especially if anything even close to what the president is proposing relating to the government, relating to the military comes to pass. Why do you think that's not shaking up fixed income markets in any material way?
Well, I think at the moment, one of the considerations is that a lot of this won't get passed through Congress. That there's enough, I wouldn't say fiscal discipline or considerable concern, but there's enough of a pushback that a lot of this won't come to pass. But I think that you're absolutely right in saying that this is a key risk. When we're looking at the equity market, we feel pretty positive about the macro backdrop and earnings. The one caveat to this, though, is that bond yields have to stay fairly well behaved. You cannot see a very significant sell-off against this backdrop. I mean, ultimately for this year, what we're expecting is that equity returns won't be driven by multiple expansion. They have to come from earnings. And any significant increase in interest rates, bond yields, could be a real hurdle for the expectations of I guess, low double-digit returns that we have.
Well, I guess to build on that, we've just seen the fastest start to a year for corporate and government bond issuance ever. We have seen $260 billion worth of sales from these entities over just the first few trading days. And I just wonder at what point you start to get real pushback from debt markets that are saying, what are we funding exactly? Is there sort of a blank check that we're offering to governments and corporations to just build to nowhere?
Coming into 2026, I think everyone's, concerned about the debt load, as they have been for many, many years. And the assumption has been that 2026 is not the year when this is going to come to a head. As long as the macro is okay, as long as the economy is doing okay, the Fed is cutting rates, then the issuance is something that companies can continue to absorb. But of course, there is a time limit to that. Now, we don't know when that's going to be. But at least just looking at the economics behind everything, which is driving the market, we do feel fairly sanguine about that. We're hoping it's a 2027 story, not a 26 story.
Seema, as a global strategist, when you see what the president is doing, the state intervention really in full swing when it comes to the United States right now, do you expect this to be a theme this year for more industries, not just ones that are critical for national security?
Well, I think that interventionist is, as you said, it potentially isn't about just national security. I think, as I said before, I think affordability is really key, which is why we're hearing so much about housing. Maybe intervention or at least pushing back from companies, or at least stopping them from passing on some of the tariff increases. I think those are all things that we could anticipate for 2026. And I think as an international investor, one of the things that we do here in Europe and across Asia is these concerns about the US outlook is one of the reasons why you are seeing this global diversification trade just gaining more and more momentum. People really starting to look outside of the US and also recognizing the fundamental strengths that exist in other countries. I don't think that we're looking at a kind of a flood of movement away from the US, but I think it does just add to the attractiveness for other markets.
How seriously do you take some of the president's statements? Because I'm thinking of just housing itself. He even said, I will call on Congress to codify it. This has to be legislation that goes through the House of Representatives and the Senate, not policy by truth.
Yeah, you have to take everything with a pinch of salt. And I think, the reason that we're not seeing the bond market react is because there is this belief that it's not going to get through Congress. So these are very popular words. Some of it inevitably, I think, will trickle through. But we're not expecting an avalanche of policy moves, but a lot of policy rhetoric should be expected ahead of the midterms.
Seema, always appreciate catching up with you. Seema Shah there of Principal Asset Management. As for the bond market, yields only up by a single basis point, 416 this morning on a 10-year maturity. Seema's right to point out that this is not necessarily a 26 story, might be 27, might be pushed out to 28 and beyond. But ultimately, you've got to take stock of things. The status quo cannot persist. The outperformance on Wall Street, met with the underperformance on Main Street, cannot persist. And I always say this about politicians, most people do too. Politicians care about one thing, staying in office. And with that in mind, it's no surprise at all that the policies, the economic policies of the left and the right are converging, because they're the policies right now that are popular. Now, they're going to keep initiating these kind of policies on both the left and the right. They're almost guaranteed for years to come. These are the kind of policies that aren't going to be welcomed on Wall Street and beyond.
Right now, all that Wall Street is focusing on are the sweeteners, the idea of what potential oomph the market is going to get or the economy is going to get from the one big beautiful bill and tax cuts. They're not looking at any kind of massive fiscal expansion of the deficit. And that ultimately is what would happen if some of these proposals went through. And I think that is the disconnect, the bond market and the stock market. There seems to be a truck you can drive through the opening between the two of them. And you just wonder at what point that gets reconciled.
I'm pleased you brought up the bond market. $500 billion boost to spending.
I mean,
on the military.
It would be actually $600 billion versus the budget this year. And according to the Committee for a Responsible Federal Budget, it would add $5.8 trillion to the federal deficit over the next decade. So that definitely is a number that would get people's attention.
There goes the tariff revenue.
Exactly.
Again, we've done that a few times.
I think it's already gone.
Yields this morning, as I say, higher by just a single basis point, 416. Lots to talk about throughout the programme today. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. President Donald Trump saying he'll ban institutional investors from buying single-family homes. The president's posting on Truth Social, people live in homes, not corporations, and saying he would talk more about the issue at the World Economic Forum in Davos later this month. Trump also saying he will request a more than 50% increase in next year's military budgets to $1.5 trillion, as you all were just discussing. The president also calling for military contractors to cut dividends and buybacks. He called out RTX specifically, threatening to stop doing business with the missile maker unless it invests more in its production capabilities. And protests erupting in Minneapolis after an ICE officer shot and killed a woman in a car during a confrontation. President Trump saying the officer appeared to be acting in self-defense, alleging the victim acted in a disorderly and obstructive way. The Minneapolis mayor has called on ICE to leave the city. That's your Bloomberg Brief. John.
Yahara, thank you. Thanks for the update. More from Yahara in about 30 minutes' time. Up next on the programme, ramping up defence spending.
Nobody has our weapons. Nobody has the quality of our weapons. The problem is we don't produce them fast enough. We're going to start producing them much faster. We're going to be very tough on the companies.
Up next, we'll catch up with Doug Redeker of International Capital Strategies, live from New York City this morning. Good morning. Pause on a three-day winning streak on the S&P 500, down yesterday, down again this morning, pulling back by 0.2%. On the Nasdaq 100, down by about a quarter. On the Russell, we're down by 0.4. Check out the bond market, yields higher by just a single basis point, 416 on 10s, really whipsawed by the economic data in the last 24 hours. ISM was pretty decent. Jolts, not so great. Then the challenger job cuts we've seen earlier this morning, Lisa, they're okay.
Yeah, they came in given at the lowest level going back to July of 2024, just highlighting that you are not seeing the firing. You saw a similar thing in the separations aspect of the JOLTS report, even though the headline number of the JOLTS data wasn't that great. What you did see was the quits rate actually ticked up, and you didn't see the layoffs really go up. So what do you do with a low fire, low hire type of environment that has just been a quagmire for all economists trying to get their hands around it?
Look for more data. Get more data
that.
at 8:30 Eastern Time. Been saying that for months. Jobless claims just around the corner, 8:30, about 2 hours away. Under surveillance this morning, ramping up defense spending.
Nobody has our weapons. Nobody has the quality of our weapons. The problem is we don't produce them fast enough. We're going to start producing them much faster. We're going to be very tough on the companies. We have the best weapons in the world, but it takes too long to get them. We're telling our defense contractors, you're going to start building faster.
So here's the latest this morning. President Trump whipsawing defense contractors, taking an aggressive stance on stock buybacks, while also pushing for a major increase to spending. Bloomberg's Jonathan Tamari joins us now for more. Jonathan, welcome to the program. Let's talk about that increase and the carrot and the stick that the president issued just yesterday.
Yeah, I think, first off, I think it's important to keep in mind that the spending piece, at least, is going to have to go through Congress. And with the president increasingly talking about aggressive action around the world and cutting Congress out of that decision-making process, I think it's very unlikely Democrats are going to write him such a big check. I do think you're seeing kind of two different conflicting aspects of the president here. That populist side of him wants to take on big businesses and show that he's not in the pocket of corporations, against the military side, the militaristic side that kind of sees these big successes like we saw in Venezuela and might want to attempt more of them.
So, Jonathan, looking at the defense contractors, I think a lot of people will be watching this program saying today, you know what, these guys, these companies depend massively on government contracts, overwhelmingly so. Maybe the government should have a say on how much executives are being paid since they're enriching themselves off the taxpayer money that comes in. Jonathan, my question would be, does this kind of thinking, this kind of pushback against executive pay, stock buybacks, extend to other sectors outside of big government contractors?
I think you're starting to see more of that from both sides of the parties. I mean, when you talk to people in politics, they'll say the divide is less now right, left, center, right, and populist and not populist. And there's a populist strain going through both parties right now, and that includes taking on corporate powers. And you hear that even from people who come from some moderate districts. It's not only the fringes of the parties anymore. So I do think this is going to be a continuing feature of politics going forward.
Jonathan, appreciate the update. We'll catch up with you again in the next hour. At least you've talked about this a few times. The two sides just convergent.
Yeah, and when you want to know the why, you take a look at the fact that wages for the lowest income earners have actually fallen well below the increases in wages that you've seen at the high income earners. And you see that inflation is being felt much more significantly at the low income sectors. That divide getting bigger, fueling that connection between the circle.
To build on that conversation, Doug Redeker joins us now, the founder of International Capital Strategies. Doug, welcome to the program, sir. A real populist twist to the last 24 hours. Is that a flavour of more to come for the year ahead going into the midterms?
I think everything's about the midterms in 2026, and we're only in the first week of January. So I think it's going to get much, much more political as we go, and much more fantasy land. I mean, what we're talking about this morning already is kind of crazy, right? I mean, you're living in a world in which you're throwing around numbers like $500 billion of additional defense spending and an enormous overreach of presidential and political authority into the corporate sector. Yes, the defense sector is deeply tied in with the military-industrial complex to the U.S. government. But still, this is stuff that a year ago even we just would have thought was crazy stuff. So, yeah, I think everything right now is Trump talking and everybody reacting. And then, as Seema said in the last sector, a lot of people are saying, yeah, but it's not going to really happen. And so how much of the rhetoric translates into reality, and what do the markets do in the meantime? I'm just very concerned about the disconnect between Trump's rhetoric, what's really going to happen on the ground, whether it's Washington, Venezuela, Greenland, or anywhere else, and how the markets interpret it. I think it's just very hard to predict this year.
Well, Doug, even if there was appetite in Washington for $500 billion more going to the DOD, could the United States afford it?
Of course not. And again, let's just remember, this is fighting the last war. So even if there was an appetite to spend $500 billion, is there anybody in the defense industry that, if you ask them honestly, would say, let's spend it on the same stuff we've been spending it on? Or are there any lessons that we all learn from Ukraine that warfare has changed? Drones are where the future is. a whole bunch of nimble, newfangled weapons that do not cost anything near what these big, huge projects have traditionally cost the American taxpayer and others. That's where it is. And Trump seems to be ignoring that. So whether it's $500 billion spent on X or Y, it doesn't seem as if any of it makes any sense in the context of where the defense industry is right now and where all the other spending commitments Trump is making seem to be in relation to the 21st century demands of the global economy.
He also went after individuals that are buying up single-family homes, those institutional investors. When you talk to clients, are they concerned about the state capitalism that we are seeing out of this White House?
It's funny. They're not as concerned as I think they should be, because I think that the premise of your question is the mantra of what America used to excel at: innovation, entrepreneurialism, and a divorcing of state control over let's not call it Wall Street, over business innovation and the ability for markets and investors to put their money where they think the investor returns are going to be highest based on their risk tolerance and innovation. That's all out the window if the government, and in this case, one particular person, the president, gets to make these decisions somewhat unilaterally. I mean, without blurring the conversation here, if you listen to what he's saying about the Venezuelan oil industry, I mean, it seems as if he wants to decide personally what's going to happen to the revenues that he's decided he's going to take and spend how he wants to make them. If I'm an investor, if I'm in the business community, I'm scratching my head and saying, is this the country that we thought the American economy was premised on? And the answer is not as clear as it was the day before yesterday.
Doug, you started by saying it's all about the midterm elections. And if I were cynical, I would say that things are getting increasingly bombastic coming out of the White House. And I wonder how much that's tied to something particular having to do with the midterm elections. Is there something you're keeping your eye on to sort of get a sense of how many proposals from from Washington, D.C. we can expect to see?
Well, I thought that the underplayed story of the week, if there is such a thing, was when Trump went to the Republican House and said, if you guys don't win the midterms, I'm going to get impeached. And I think that was a tell for what's on Trump's mind. Not that he cares so much about being impeached and ousted from office. It's highly unlikely that the Senate would convict, even if the House impeaches. But I do think he's looking at a political environment that is much more fragile than he would like it to be. That's going to impact his own confidence in how he rolls out these policies. He's obviously increasingly autocratic in his rhetoric, at least, and Congress is increasingly fragile in terms of the House majority. So looking at the midterms is going to color everything, because that really determines whether he can continue to act the way he's acting, or whether his political capital starts to dwindle, and maybe on an accelerating basis as we roll through 2026. You know, there's been a lot of people in Washington who say once Trump's favorable ratings drop below 40% consistently, then suddenly some Republicans might actually think it's in their interest to start bucking him. Well, he's not consistently below 40%, but he's kind of nudging down there. You've got a couple of 36s and a couple of 38s. Maybe they're outliers, but they're more consistent than we've seen before. I think that's going to impact Trump. I think it's going to impact how the Congress looks at backing Trump on some of these wild ideas. And we're in the second week of January. So, you know, this has really got a long run to play out as we run into the midterms. But midterms are really all what 26 is going to be about, I think.
It's going to be quite a year. Doug, it's good to see you, as always. Doug Redeker there of International Capital Strategies, the president setting the tone for the year ahead.
And when it comes to the midterms, this is also what we saw play out yesterday in Congress. You have 9 Republicans voting to advance a bill when it comes to the enhanced Obamacare subsidies. These are moderate Republicans in swing districts. Why? They want to get reelected.
Big year ahead. Coming up on the program, Neil Dutta of Renmac as President Trump vows to ban corporations from buying homes. Plus, Danny has your morning move with some big moves for defense names. Looking at the potential for a two-day slide on the S&P 500, down only slightly this morning. We're down by 0.2%, down by 0.25% on the Nasdaq 100. So much to talk about in the last 24 hours. A shaky moment for the home builders, for Blackstone yesterday, a more interventionist White House. on the horizon. Lots of suggestions. Will it actually result in actual policy? I've got no idea. But to Lisa's point, in the bond market, if you're looking at an extra $500, $600 billion in defense spending, then the Treasury market's got to have a say here, right? At the moment, 10's doing okay at 416.
How much is this just a bond market participants saying this isn't going to happen, it's not going to pass? Because at this point, if you're looking at the Committee for a Responsible Budget and saying it could increase the deficit by $5.8 trillion, that's not pocket change, right? That suddenly is a significant amount, especially when you counter in interest payments. So it raises a question. Are they ignoring it? Is everyone just shrugging it off? When is a risk factor actually becoming a risk factor, considering that people are looking to just completely look through any rhetoric?
It's been somewhat snoozy in the bond market, I can say that. The 10-year bond yield in a range of 4 to 4.20 for something like the last 4 months, and we're kind of in the middle of it at the moment at 4.16. As we count you down to the opening bell, 2 hours away, 3 hours away. Let's get you an update on some morning movers. Here's Danny with more. Hey, Danny.
Hey, John, I'm starting there with the defense companies, because what a roller coaster it has been. With Trump yesterday, his executive order of no dividends, no stock back, capping executive pay, that sent all of these shares lower, specifically RTX. He called out Raytheon, saying that they're not going to do any work with the U.S. government until they figure out how to more fastly develop weapons for the government. And then, as you mentioned, late yesterday, we get another truth post where Trump says that they're going to massively increase defense spending. And that's why you're getting a rally in the pre-market, 5%, 7%, 7.6% in the case of Northrop Grumman. Elsewhere, AbbVie, those shares are falling this morning alongside Revolution Medicines. They are a maker of cancer treatments. Late yesterday, the Wall Street Journal reporting that AbbVie was close to a deal for buying it. Shares surged 23% of Revolution Medicines. They're back this morning because AbbVie told Bloomberg that, nope, we are not buying the company. I should say Wall Street Journal, they are sticking with their story, and you're not completely seeing that premium getting priced out of Revolution Medicine. Again, only down about 10% in the pre-market. Finally, some earnings. Constellation Brands reporting yesterday. This is the beer maker of Modelo and Corona. Those shares up 2.3%. They surprised to the upside. They reaffirmed their full year guidance, but expectations were so low. RBC pointing out that thanks to profitability, things did well, but it is the concern around Hispanic customers. The company emphasized this, saying that because of what's going on in the political environment, Hispanic customers are pulling back in the U.S., and a loss of what they called 4,000-calorie jobs like construction, agriculture. Weakness in that sector is also leading to lower sales. John.
Interesting read through. Danny, thank you. Appreciate it. More from Danny in the next hour. On our radar this morning, President Trump demanding a $500 billion increase in annual defense spending, calling on firms like RTX to freeze buybacks and dividends, threatening to cut them off unless they pour those profits back into production. Elsewhere, the U.S. expecting to control as much as 50 million barrels of Venezuelan crude. In an interview with the New York Times, President Donald Trump saying the U.S. will be extracting Venezuelan oil for years, adding, we will rebuild the country in a very profitable way. And finally, Chinese officials reportedly planning to approve some imports of Nvidia's H200 chips. Sources telling us here at Bloomberg the technology will be blocked from military use, but will be allowed for select commercial use.
Yeah, and this is something that had been increasingly expected based on rhetoric coming from both sides. There had been some questions over the past 24 hours about whether the Chinese government was going to freeze this based on some of the tit for tat between the two nations. But what is clear is that China still relies on U.S. technology in a significant way. So for all of the goals of trying to be self-reliant, clearly that is not the case, and the interrelation continues.
It clearly was baked in based on what Jensen Huang was hearing directly from customers. He told Ed Ludlow, we are seeing an indication that there is a lot of demand, that these individuals want to go in with the purchasing of it. What I find interesting is that they're going to be barred from military use, sensitive government agencies, critical infrastructure, and state-owned enterprises due to security concerns. They start thinking about how China is operated and run. Who actually is going to be able to maybe buy some of these chips?
The stock this morning positive by about 0.5%. One to watch going into the opening bell. Let's talk about housing. President Trump blindsiding Wall Street, posting on Truth Social he would immediately take action to ban institutional investors from buying single-family homes. Trump saying, quote, people live in homes, not corporations. Neil Dutta of Renmac had this to say. Seeing limited impact, he writes, institutional investors represent a very small share of sales, like 2%. Institutional investors are a nice boogeyman, but this is not the issue facing housing. Neil joins us now for more. That was Dutta light. This is Dutta full fat. Going after Blackstone is what a tired lib should do, not DJT. Neil, it's good to see you. Walk us through why this might be politically popular, but might not be that effective.
Well, it's not effective for the reasons I just mentioned. I mean, it's a very, very small share of sales. In some cases, you can make the argument, particularly in the Sunbelt areas, the fact that you have institutional buying is actually allowing people to rent in homes that they otherwise wouldn't be able to buy in the first place. So, they provide a sort of backstop, I think, particularly for home builders. I'm sort of a markets guy. I mean, if, any good housing policy, if it's going to incentivize construction, you'd probably see the home building stocks rally on the news. Instead, you didn't. Obviously the home builders sold off. But this isn't really the main issue facing housing, John. The main issue really is people don't want to sell their homes because they have low mortgage rates that they don't want to give up. So that to me is the main issue. But this is sort of a nice kind of bright, shiny object for the economically illiterate.
Neil, what you're getting at is important because for a lot of people, the starting point of this conversation is we have a supply shortage. What can we do about it? Are you pushing back against that?
Yes, it's very challenging to say that you have a supply shortage with home prices declining in many parts of the country. It's very difficult to say you have a supply shortage with new unsold completed inventory rising going into this year. Home builders, if you look at some of the private data, home builders are sitting on the most completed unsold inventory that they have really since 2010. So how is that consistent with the housing shortage? I mean, I think the housing shortage conversation is really, it's sort of a fake concept, I think. I mean, it's really at what interest rate, at what price? Clearly, if you have prices declining, in the Southeast, parts of the West, it's hard to make the case, and that's where the homes have been getting built. I mean, it's hard to make the case that you have a shortage there.
Neil, you said that it's an attractive proposal for the economically illiterate. For the economically literate, some people might point to interest rates, like you just said. And the key here is getting mortgage rates low enough to actually encourage people to sell the homes that they're sitting on. How do you think that this president is going to try to do that at the same time that there is this sort of expansion of the fiscal deficit?
Well, I mean, the options are limited. Obviously, you can't... Fed policy obviously isn't the only thing that drives longer term interest rates, right? So, I think there's things the administration can do by putting people on the Fed that maybe they're willing to, for one, I mean, Mickey Baumann goes around talking about selling MBS out of the Fed's portfolio. I think she should probably stop doing that. That could be helpful. You could maybe talk about Operation Twist on the Fed's balance sheet. That could be helpful. But in terms of something the administration can do, I mean, the president can influence those through potential future Fed nominees. I think the thing the administration can do is maybe try to use, the help of Congress and potentially using the tax code to mitigate the effects of mortgage rate lock-in.
I just wonder, Neil, if at a time when people are looking at populist proposals coming from the White House, the potential for $2,000 checks, the potential for the expansion of fiscal stimulus throughout the economy, how much does that push the Fed away from cutting rates more aggressively and actually increase the risk of inflation despite this concern around the housing market?
Well, I think, Lisa, the proof of the pudding is in the eating, right? I mean, I think, to what you're talking about with the defense companies, it's how much of this is real, how much of this is rhetoric, in a midterm election. I think getting any kind of proposals around housing, especially because there are lots of entrenched kind of interests, it's probably very difficult to get it over the finish line.
Neil, does this set up the president potentially when you think of things like lock-in and mortgages? Does it set him up for potential confrontation with banks? Because what you're basically talking about is what the United Kingdom does, which is portable mortgages.
I mean, portable mortgages could be a very good idea if you think about it. I'm not a housing legislation expert, but as I said, I mean, I think a generally good first principle is how do we get more building, not how do we limit who can buy. I think that should be the driving principle for how we think about addressing housing challenges going forward.
Well, the president all summer, the Treasury Secretary talked about potentially they've been weighing this idea behind the scenes of creating and talking about that there is really an issue when it comes to housing going full throttle. So this could just be the beginning of it. What advice would you be giving to the Treasury Secretary at this moment?
Well, I mean, thank you for that, Annmarie. I'm not sure that I'm the one to be giving him advice on housing, but as I just mentioned, it's about trying to increase building, not limit buying. And I do think that, look, I mean, options are limited, but as I said, there are two things that the administration can do. Number one is to put people on the Fed that can find innovative ways using the Fed's balance sheet to bring down longer term interest rates. I just mentioned Operation Twist. So talk to the future nominees about that. There's a potential to nominate 2 people this year. And the second is use the tax code to mitigate mortgage lock-in effects. The main issue going on with housing is that people don't want to give up their low mortgage rate if they wanted to get into a new house. So you can use the tax code to basically do what home builders have been doing over the last number of years. We'll buy you down for a couple of years to sort of mitigate the costs of going into a higher mortgage rate product. So it's essentially getting at that portable mortgage sort of through the tax code.
Neil, I think we've got to finish on why we're even talking about this. The midterms are coming up at the end of the year. Affordability is very much in focus, and there's some real tension in this country at the moment, economically speaking. The top of the country, the 1%, doing tremendously well. Anyone with assets, fantastic. And if you own your home already, brilliant, especially if you've got a 2% mortgage. Neil, for a lot of other people who don't have access to all of that, Bramo, thank you.
Anytime.
Neil, for a lot of people who don't have access to all of that, they're looking at solutions that are coming from the extreme ends of the political parties. And Neil, I just wonder as an economist how you're thinking about these issues going forward as to whether the status quo can persist.
Well, I think that the notion of affordability, I feel like it's almost like a catch-all, right? I mean, I think to me, the main story going forward isn't going to be people being worried about affordability because of actual prices, but because they lack the employment opportunities to pay for things. And that to me is the next sort of challenge going forward. I think it's interesting. I mean, when the public is worried about things like inflation, I think in some cases they're sort of fighting the last war. And I do think that actual inflation rates will moderate a lot this year. But that doesn't mean that household anxiety is going away, because I think it'll be something else that people have to worry about, which in this case will be employment. So that's sort of how I see things. It's sort of a challenging time. I think if you get some rate cuts later this year, we'll probably be in much better shape going into 2027.
Neil, who do you think is going to be the bogeyman if the labour market starts to roll over? Through GFC, when we came out of that, obviously the natural target was the banks. What's the target this time around?
Well, I mean, in some cases, it's the government itself that's the boogeyman, right? I mean, if you look at obviously what's going on with Doge, I mean, the president took to Truth at one point saying that one of the reasons why the unemployment rate had gone up was because of, sort of the right sizing of the federal government. I mean, that's only partially true. But in some cases, he's the boogeyman. And state and local governments are also very, very weak. But if you, look, it's going to be very, very challenging to sort of say, when you have sort of a broad-based labor market slowdown, to point to one person or that person, going after the entire corporate sector, in an economic slump and creating additional uncertainty on their backs is not necessarily the best way to turn things around. So, to me, I think it's always best to sort of focus on how are we going to grow things, and step one is always do no harm. So.
Neil, it's good to see you. Happy New Year. Thanks for joining us.
Happy New Year. Congratulations, by the way.
Hey, thanks, buddy. Appreciate it. Neil Dutter there of Renmac. Neil Dutter on the situation in the economy and the labour market. And we didn't talk about one particular target. Maybe it's going to be tech. At the same time, we're developing all these AI things, which could be tremendously effective for the economy and drive a massive bounce in productivity. I certainly hope so. If it happens at the same time that you're not seeing great employment prospects, that's going to be a natural target.
Especially because it's going to increase prices, particularly with electricity. So people will see the prices going up, but they won't necessarily see the employment options also increasing. We've been talking about how this has been a White House that has been a champion of big tech in the United States. You're already starting to see the pushback from small corners in both parties.
And when it comes to electricity, you already saw that in the midterm elections. When it comes to Virginia, when it comes to New Jersey, this was one specific issue. And Virginia itself has a ton of data centers. So already this is becoming a political problem, and it's just going to get worse as we drive into November.
If you're just tuning in, welcome to the programme. Futures a little bit softer, down by 0.2% with an update on stories worldwide. Back with us with your Bloomberg Brief. Here's Yahira. Hey, Yahira.
Hi, John. President Donald Trump saying Venezuela will buy only American-made products with the money it receives from oil sales. The purchases will include American agricultural products, he says, medicines, medical devices, and equipment to improve Venezuela's electric grid and energy facilities. Meanwhile, Secretary of State Marco Rubio telling lawmakers that recent threats against Greenland do not signal an imminent invasion. Rubio saying the United States' goal is to buy the island from Denmark. He plans to meet with Danish and Greenlandic officials in Washington next week. President Trump says the U.S. needs Greenland as a matter of national security. And OpenAI is introducing ChatGPT Health, a feature that will allow users to analyze medical test results, prepare for doctor's appointments, and seek guidance on diets and workout routines. Things we already do, right? ChatGPT Health will be able to connect with electronic medical records and wellness apps. OpenAI says the service is meant to supplement, not replace doctors. That's your Bloomberg Brief. John?
Yara, thank you. To Yara's point, things I already do.
Oh, yeah?
Blood test results, push them in, take my name out of it.
Yeah, exactly.
Yeah.
Like anyone I know.
But you should still see a doctor.
I don't rely on them.
But the truth is, doesn't that sort of remove some fun from life? You know if you're going to have that Big Mac, that suddenly your blood tests are just going to go off the charts?
Oh, right. Okay, yes. No, I just mean when you're going to speak to your doctor about some results and they send you the results and you can't read them properly and they don't make any sense at all.
That's true.
I just want an early read. I don't want a shock
when
I get that phone call.
I don't disagree.
I've already seen them. I've got a decent understanding.
I know.
And I've got these fantastic questions to ask.
I'm sure
it's like, who is this guy? Why does he know so much?
According to page 323 on the work manual.
Up next on the program, making Venezuelan crude great again.
This was a deal made by the president and his team with the Venezuelan interim authorities. All proceeds from the sale of Venezuelan crude oil and products will first settle in U.S.-controlled accounts at globally recognized banks.
Up next, we'll catch up with Amrita Sen of Energy Aspects. Equity futures are lower by 0.2% on the S&P, down by about a quarter on the Nasdaq. In the commodity market, positive by 1.5 on WTI, still sub 60, 56.81. Under surveillance this morning, focused on energy, making Venezuelan crude great again.
This was a deal made by the president and his team with the Venezuelan interim authorities. All proceeds from the sale of Venezuelan crude oil and products will first settle in U.S.-controlled accounts at globally recognized banks to guarantee the legitimacy and integrity of the ultimate distribution of proceeds, and those funds will be dispersed for the benefit of the American people and the Venezuelan people at the discretion of the United States government.
So here's the latest this morning. President Trump set to meet with major energy executives tomorrow as the U.S. is gearing up to rebuild Venezuela's crude industry. Amrita Sen is the founder and director of market intelligence at Energy Aspects, and she joins us now for more. Amrita, it's your job to explain just how this is actually going to work in practice.
I think the first set of conversations the U.S. company executives have had with Chris Wright, what is coming out is exactly what we have been highlighting. No company is going to jump to be the first to go in. We are looking at infrastructure which is heavily destroyed, depleted. It is going to take hundreds of billions of dollars and years to really revive the Venezuelan upstream industry. So there needs to be significant guarantees by the government. We've also talked about the fact that these companies don't even know who they are dealing with in Venezuela, right? Is the government there legitimate? Will any of the contracts being signed honored later on, let alone PDVSA's huge amounts of debt? So this is an extremely complicated situation. I appreciate a lot of numbers have been thrown around in terms of, the new oil that could come out of Venezuela, but we are really talking about a trade flow shift as the main repercussion of what's going on there. So I think you're going to see more oil go to the US at the expense of China, but not necessarily significant increases in Venezuelan production. Because even just 500,000 barrels per day of Venezuelan production increases, we calculate, would take about $10 billion in at least 2 years.
Amrita, how much oil was going to China when this all happened? How significant are these flows as a source of power for that nation?
China was taking about 500,000 barrels per day of Venezuelan oil. It fluctuates, but on average about 500 or so. And the U.S. was getting about 140 to 150,000 barrels per day. Those were the Chevron flows that were allowed under the licenses agreed earlier last year. So the point is that if you then redirect all of those Chinese flows to the U.S. as well, we've done some calculations. We do think the U.S. refiners, which are very complex, they do want the heavier crude oil discounted Venezuelan oil. They could take about 600,000 barrels per day, backing out some Canadian crudes, backing out some Mexican crudes, and even backing out some U.S. shale production itself, because, again, when you're optimizing a refinery diet, and you're putting in these heavier barrels, you will displace some of these other crudes. So I think that's the main shift. And then China will have to figure out, the Chinese teapots who used to buy Venezuelan oil will have to find alternatives. They tend to buy sanctioned oil, so you're looking at more Iranian. And if they can't get any more of that, then they will just have to cut runs and others will have to make up for it.
Amrita, overnight, the Wall Street Journal says that Trump repeatedly raises the idea of bringing oil prices to $50 a barrel. What kind of friction can we see between the White House and OPEC?
Well, look, OPEC have already started the unwind process last year. They've added, well over 2.5 million barrels per day of production. Now, actual increases have lagged quite significantly because a lot of countries were already maxed out. And I think that's going to be a talking point later on in the year in 2027, not right now. The fact that OPEC spare capacity, is pretty much running out and concentrated in the hands of very few. OPEC can't really do very much more. They've paused over Q1. They could resume, and we do expect them to resume the increases for the second tranche that they're unwinding after that. And I think it really does show the fact that oil prices are still holding at about $60, despite the fact that everyone's talking about this massive surplus, that something isn't adding up somewhere.
Well,
Either
Amrita,
demand is better than expected.
Could we see prices go up if they continuously go after the shadow fleet?
Yes, that's definitely a possibility. To be clear, we are building. So I'm not talking about a market that is tight. There is a surplus in the market. The question is how big a surplus? Because if people are expecting 4-5 million barrels per day of surplus, then we can go to $50. But if not, and they go after the shadow fleet and, for instance, keep more oil off the market, like we just heard this morning, Russian unsold oil is over 100 cargoes right now. That's what's keeping the market tight and prices at 60. Otherwise, we probably would be a lot lower today already.
Amrita, thanks for jumping on and breaking it down. Amrita Sen there of Energy Aspects. Crude positive this morning by 1.6%. That shadow fleet coming into sharper focus in the last week.
Oh, absolutely, especially yesterday when we actually saw the U.S. board a Russian flag ship. The Wall Street Journal overnight talking about how Trump wants $50 a barrel. The reason why I'm focused on this is because he just had Mohammed bin Salman at the White House. They want $90 a barrel. At some point, are we going to see a bit more of an aggressive OPEC trying to get the price higher?
I'm not sure the executives he's meeting with in the next 24 hours want crude in the 50s, do they?
Well, if you look at what the Financial Times is saying, as some of them, and I've heard some of this behind the scenes as well, pretty much the rhetoric is we're lining up to go to lunch at the White House. We're not exactly lining up to go to Caracas.
Yeah, I think that's a no.
Yeah, I think that right now. How do you do that with social media potentially skewing your plans?
In the next hour on Bloomberg Surveillance, we'll catch up with Jim Zelter of Apollo, Bloomberg's Jonathan Tamari, Mira Pandit of JP Morgan, and John Lovello of UBS from New York City. You're watching Bloomberg TV.
The economy is kind of treading water.
Not a lot of hiring, a lot of caution. We've just been consistently trending higher in the unemployment rate.
Strength in the labor market, I think, eventually could cause some of that soft economic data to catch up.
The economy could grow even when we have a labor market that's not growing much at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Following 3 days of gains on the S&P 500, we hit pause in yesterday's session and pulled back again this morning, down by 0.2% on the S&P, on the Nasdaq down by a third. On the small caps, the Russell negative 0.4. The week ahead shaping up as follows. Lots of jobs data in the next 24 hours. The big one, of course, payrolls Friday just around the corner. Later this morning, jobless claims at 8:30 Eastern time. That's one to watch. A sprinkle of data earlier on this this morning, not so bad.
Yeah, right now we've gotten challenger job cuts announcements that really fell to the lowest that we've seen going back to July of 2024. And this builds on other not so bad news. It isn't runaway, the labor market is going gangbusters kind of news, but it is better than potentially we're falling off a cliff type of news, which is the reason why people are watching for jobless claims later this morning. If you see a reiteration of the low read that we got at the end of last year during a very muddied month, do people get a sense that this is a labor market that's actually in recovery, not in decline?
We are all long this economy. I hope we see that bounce. If we don't see that bounce, I imagine we'll see much more of this. Populist policies coming out of Washington.
Non-stop policy news flow yesterday, and we just got a note out from Tobin Marcus of Wolf Research talking about the fact that this is the second week of January. We've had a capturing a Venezuelan leader. We have the president talking about minimizing stock buybacks and dividends with the defense companies and then whiplashing them and saying, actually, though, I might want to spend $500 billion more on defense, and then also talking about what he can do when it comes to housing and affordability. And Tobin says these competing priorities all colliding, that they're just going to collapse under its own weight.
Defense contractors have been whipsawed. Home builders, Blackstone, been hammered in the last 24 hours. Check out the bond market. Lisa, right to point to this. Yields higher by a basis point or two, 416, in between the range of the last 4 months or so, 4% to 420 on 10s. But is this market wide open for an extra $500, $600 billion of defense spending?
I mean, essentially, it's saying yes, right? I mean, essentially, it's saying we can absorb it, because if they're actually considering the fact that you have a $5.8 trillion increase in the fiscal deficit, you would expect yields to rise a bit more. You have to wonder, when you hear all of the proposals coming from the White House over the past 36 hours, what do we solidify on? It is an expanded deficit. There is no hawk left on Washington, in Washington, D.C. And if that's the case, why isn't the bond market reflecting that a little bit more?
Well, the bond market might be looking at what is going on in terms of the numbers in the House of Representatives and the Senate and just thinking, okay, $500 billion more defense spending, that's not going to get through. Maybe they'll give him a little more for the Golden Iron Dome and the Golden Fleet. And then Trump himself, when he talked about the housing truth, said, this is my idea, but I need Congress to codify it. Well, guess what? I don't think Congress is lining up to codify
It's a pretty depressing morning for the senator from Kentucky, isn't it, Rand Paul?
Yeah.
How do you think he feels about all this stuff?
Not well, and he's been quite honest about that. Him, Thomas Massie, a lot of these individuals are not lining up for this.
There aren't many of them left down in Washington, as Lisa said. Equities right now, the S&P 500 down by about 0.2%. Great lineup this hour. We'll catch up with Jim Zelter of Apollo as equities pull back from all-time highs. Mira Pandit of JP Morgan as markets await a fresh labour print. And John Lovell of UBS as President Trump's latest housing reforms rattle Wall Street. We begin this hour with stocks edging lower as investors weigh a slew of new risks. Apollo Global Management President Jim Zelter writing the following. 26 U.S. outlook is consistent with a stagflationary environment, and we expect interest rates to be higher for longer. Jim joins us now for more. Jim, good morning.
Good morning, John. How are you? Happy New Year.
I'm well. It's good to see you. I want to pick up on this headline from our friends over at the FT in the last month. Apollo's cutting risk and stockpiling cash. Is that true? What are you guys up to?
Well, I would say that we've always been known as a disciplined investor. We talk about purchase price matters. We talk about alignment with our investors. And I think that what that statement is, it's really about the gauntlet for approving investments at Apollo has gotten higher and higher over the last year or so, as we see an environment that down the fairway, I'll use a golf analogy, down the fairway, you've got a lot of great things going on. Massive CapEx cycle, good economic growth, consumer in solid shape, a variety of great attributes. That being said, the rough, where there's lots of challenges, between geopolitics, between the concern about inflation, between the concern about the return of invested capital in AI, there's a variety of left tail items that have certainly grown in stature. As I listen to some of the macro commentary here, I think there's a great deal of humility about the macro view of how the predictions, I've said here many times, we sat here after SVB, we all thought massive capital slowdown in spending and credit crisis. The U.S. economy really was massively resilient. You guys talked earlier about what's going on with the deficit. I think it's a little bit, it's the economy stupid. The U.S. economy, people just don't want to short the great momentum of what's going on. And we have an administration that's very politically savvy about populist topics. He's been very responsive. But I just back to the question you had, we're putting money to work. This week was a busy week. We announced $6 billion of deals, of transactions, all great companies, again, we're leaning into larger companies that are part of the global industrial renaissance. One with Brad Jacobs, a 40, 35-year winner in the building product space. The second one with Russell Investments, really simplifying their capital structure. And then the last transaction was very interesting, actually. It was for Valor XAI. It was really a sale leaseback on a massive amount, $5 billion of Nvidia chips. So all three really interesting transactions, but really well structured, downside risk. And I think that's our view right now. We want to be investing capital, but you got to acknowledge you can wake up on a Saturday morning and see us with activities around the globe that really enhances the tail risk of geopolitics. You can get a stroke of the pen announcement yesterday with regard to housing. And so I think you have to be very, very careful about how you invest long term at scale.
To extend the analogy, though, to your point, the fairway is getting narrower, the rough is getting deeper. In the last few years, it's not been that way. Allocate to risk and you'll perform, you'll do well. It feels like a tougher environment.
The analogy for golf, for those who play a lot of golf, is we're at the U.S. Open. The U.S. Open is known for tight fairways and really punitive rough. And if you cape in the fairway, you're going to be a great victor and you're going to have great success. I think there's going to be, as last year will remind us, you can have some bumps in the road during the course of the year that definitely change the trajectory on liquidity, on momentum, on risk appetite. So, but I think the long-term trend is quite positive, but I do think you have to be very measured about how you execute your business model.
So if that's the U.S. Cup, do you go to the Ryder Cup?
Oh, I'm
sorry.
U.S. Open.
There you go.
No, I mean, the idea, do you expand your... I Googled that, and evidently I bombed it. But I just am curious if you go overseas, because to diversify away from the United States.
Well, we've been, I would say to account that, we've been very vocal, and I've been vocal on this program about Europe. When you look at the needs of governments around the globe, especially in Europe, in Germany in particular, and so more so in the UK, the government's demand for capital far outweighs their ability to participate. And so we want to be part of that renaissance in that part of the globe. In places like Japan and Australia, we want to be part of the retirement solutions and some of the global industrial renaissance with a changing banking system. We're not broadly speaking, a developing and emerging markets investor. So while we have a view on what's going on in Latin America today, that's a negligible part of our capital. That's just not what we do. We're really a G7 and larger economy investor.
So you were talking about how you're getting more conservative, yet corporations and governments are tapping the market at a record pace so far this year. About $260 billion of bond issuance from governments and corporations around the world have been issued, the fastest pace ever.
Yeah.
Is this because there is a lot of optimism out there, or is this because they see a small window that could close and they want to get in?
I don't think it's a small window. When you look at the numbers that have been put out by the large financial institutions, the big banks, about net issuance in the IG market, it's north of it's anywhere from 800 billion to $1.2 trillion net issuance, which is one of the largest numbers in the last 10 to 15 years. Same can be said in the high yield and the leveraged loan market. The net issuance is going to be quite high. So with real rates and real yields fairly high on a historic basis, with a variety of pensioners and investors around the globe looking for long duration yield, it's a pretty powerful mix of supply and demand in terms of taking that overhang, if you will. I think one of the big questions is, does the equity new issue IPO calendar actually come to fruition? And the second thing that people aren't talking about is where oil is right now, it's very deflationary. If it were to stay at these levels or even go lower, again, we're talking about all the things that can go wrong. I'm a credit guy. Bonds don't go to 200; they go to 0. I'm cautious by definition. But in oil at these levels on WTI at 56, 57, that's very deflationary and very positive for economic growth. So, again, I think that there's a variety of balancing acts here going on. But to John's first question, I would say that we think that there's a variety of issues that one needs to deal with, but at the same time, you want to be putting money to work in large scale. Now, if you look at the traditional high yield market, the CCC LBO buyout, that activity is just not happening in scale anymore. It's being funded in private credit, which I'm sure we'll talk about because of our big white paper in December. But at the end of the day, it's really about credit and the ability for this IPO calendar to come to fruition.
Let's build on some of this, Jim, because I can tell you sort of openly and honestly what I've struggled with. I don't know what to look at anymore. Payrolls has been a bit of a head fake in the last 12 months. We've seen a real deceleration in payrolls growth, but it's not been relevant to the performance of risk assets more broadly. Something that you and the team have talked about for a number of years now. When we saw interest rates go to 4%, pushing 5%, Lisa and I were talking about this for the best part of 12 months. How on earth is this economy going to deal with 4 to 5% interest rates? And we dealt with that just about okay. What should we be focused on?
I think I think to answer that question, it's really, we talk about the changing backdrop of market structure. The reality is in the U.S. today, it's been an extended credit cycle. It's harder to have a real economic recession because of the diversity of funding across the board. We have the healthiest banks in the globe. We have a securitization market that's alive and well in record size of issuance. That disperses a lot of risk around the economy in terms of balance sheets. You know, you have a consumer in pretty good shape. You have a housing market where 40% of folks don't have a mortgage. I'm not saying we're not going to have an economic cycle. We will have an economic cycle. We will have a credit cycle. But if the post-SVB environment is any lesson to us all, because of the advances and the evolution of the U.S. economy since the GFC, it's a lot harder to push over this machine than it had been in the past. The transmission mechanism of the Fed that used to be instantaneous is not what it used to be. We saw it in the last 2 years with housing in the U.S. Because of the 30-year mortgage concept, or the lack of a mortgage, versus countries like the UK, where most folks are on a 5 or 7 year floating rate mortgage, that has an immediate impact on the brakes of the consumer and the economy. Not the case in the US. So the strength, the breadth of market structure, how companies finance, the role of banking, the ability for the Fed to actually have that transmission mechanism of raising rates and slowing the economy down, it's not what it used to be. It's not your father's economy.
Jim, you're going to stick with us. Apollo's Jim Zauter with us for the next 15 minutes or so. Let's give you an update on stories worldwide this morning. Let's cross over to Yahira to get an update on your Bloomberg brief. Hey, Yahira.
Hi, John. More than 1,000 companies are lining up in hopes of recouping their share of billions of dollars in duties. The U.S. Supreme Court is poised to decide the fate of President Donald Trump's sweeping tariff policy as early as tomorrow. The administration has collected approximately $133 billion in duties under the emergency authority as of December 14th. Meanwhile, oil traders and refiners are rushing to position for access to Venezuelan crude after President Trump said the U.S. will take control of up to 50 million barrels of the country's oil. In an interview with the New York Times, the president saying only time will tell how long the U.S. will maintain oversight of the country, but when pressed, he said it could be much longer than a year. And here in New York, Governor Kathy Hochul and New York City Mayor Zohran Mamdani announcing a major new investment for childcare in the city. The plan would provide free childcare for all 2-year-old children. No details were released about the cost or how it would be paid for. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. More from Yahira later this hour. Up next on the program, restoring the American dream.
I am bringing those high prices down and bringing them down very fast. I will announce some of the most aggressive housing reform plans in American history.
Up next, we'll catch up with Bloomberg's Jonathan Tamari, and we'll get a little bit more from Jim Zauter of Apollo. Live from New York City, welcome back to the program. Looking ahead to some job numbers a little bit later, 8:30 Eastern Time. We'll get jobless claims tomorrow morning. 8:30 Eastern Time, we'll get the payrolls report. The estimate in our survey at the moment, we're looking for 70K. That estimate just kind of inching higher in the last 24 hours. In the equity market, the price action looks like this morning. Futures negative by just 0.2% on the Nasdaq, down by about a third. Under surveillance this morning, restoring the American dream.
We're bringing our economy back from the brink of ruin. I am bringing those high prices down and bringing them down very fast. You will see this in the new year. I will announce some of the most aggressive housing reform plans in American history.
So here's the latest this morning. President Trump taking a swipe at big business, announcing his plan to ban Wall Street from buying single-family homes. The White House looking to address housing affordability ahead of the midterms. Bloomberg's Jonathan Tamari joins us now for more. Jonathan, the president's own words, I will announce some of the most aggressive housing reform plans in American history. What can we expect?
Well, we saw his announcement yesterday that he's looking to ban big institutional investors from buying new homes. The idea is to try to drive the price down there. The big challenge there is will that stand up legally? Will he need approval from Congress? And how much housing do they really own? If you look at the overall market, it's a relatively small amount that's owned by these big institutional investors.
Jonathan with the latest down in Washington. Jonathan, thank you. With us around a table, Apollo's Jim Zelter. Apollo, not Blackstone. That's an important distinction, Jim. You're not big in this space.
No, as a matter of course, we are not.
Why historically has that been the case?
You know, it's something that was not. It was not down the center of how we thought about investing our capital. As I've reminded you all for many times, for us, most of our capital, half of our capital is our own balance sheet, and we wanted to focus more of our activity on the big choke points of housing. Housing is a massive issue. We saw it in New York City with our election, affordability around the country. There's a lot of demographic reasons why, and we've just chosen to be much more on the choke points of the strategic growth. How do we actually help create more property for home builders and developers? How do we really create the choke points of building products and things like that? But we've just not pursued this for a variety of strategic activities. But I think what's going on right now is the president is saying a symbolic North Star laying out, but they're also going to work on a variety of massive strategic initiatives that will allow the social good to be dealing with this problem. Because it's not only in the US, but it's in the UK, it's in a variety of other countries. We don't have the zoning issues that the UK has. But certainly in terms of affordability and starter homes, and whether it's initiatives to allow for subsidized mortgages or quicker building of standardization or a relaxation of the zoning rules. I mean, these are all activities, but we're not in the core franchise of this, so it has no impact on our franchise.
You're not directly exposed, but do you think this idea of banning large institutional investors from buying up single-family homes is the right policy approach?
You know, we have an administration that's chosen to do a variety of things, whether it's taking equity in large technological companies. I think there's better ways to actually solve these strategic issues. They have identified challenges that are affecting many, many Americans and many companies. But at the same time, I think there's broader policy strategies that can help out to solve those problems. And I would say for us, you know, you don't get to the size that we've gotten without participating, whether it's retirement, the Industrial Renaissance, or other big initiatives that help society out. So we want to be on the strategic helping side rather than the debate about policy.
What is strategic helping? I mean, we saw this with JP Morgan's recent fund, their $1.5 trillion fund.
Yeah.
Where are you expanding? You
know, kudos to JP Morgan and Jamie for doing that. It's really consistent with, you know, pro-U.S. policy. We're in dialogues with them and many others on a variety of funding the choke points in the defense initiatives. We're doing a variety of things in the housing in terms of land banking for builders and otherwise. All the things we've been doing in technology, getting chip building back in the U.S., those are all the things that we think are good for U.S. long-term, whether you're on either side of the political party agenda.
Can you frame capital needs for us in the private space at the moment? I'm going to reduce it down to one company.
Yeah.
Feels like a lot of this year is centered around OpenAI, their capital needs, and whether they'll be met or not. And that's going to set the tone for risk appetite for the year ahead.
Yeah.
How small is that compared to the bigger pool?
You know, when you look at the number I used earlier was over the next 5 to 6 years, it's been bantered around that the hyperscalers in aggregate are going to need 5 to 7 trillion. You know, when you think about how that's going to be filled, about a third of it will be filled from their free cash flow, not OpenAI, but the other 6. The high yield market, the investment grade market, the structured finance and ABS market, they will all fill that. When you identify the gaps, it's another trillion of the 5 to 7 trillion, about $1 trillion, $1.5 trillion has not been identified. that seems like it's a huge number. As I was mentioning to you earlier, U.S. economy, 30 trillion plus economy, global economy, almost 125 trillion. So it's a big number. It's definitely going to strain and have an impact on the IG issuance markets, where these companies were negligible participants. Now they're going to be 10 to 15% participants. But I think that's when you say to me, what are the questions that I would love to know for year end 26 or 27? I'd love to know where oil is. I'd love to know where 10-year bonds are. And I'd love to know what the return on this capex of broad AI data centers is. And if you knew those would be great demarcations of success. But I do think there's a big question about the return on invested capital on some of these companies.
There's a bigger question about return on invested capital for the biggest in the private debt and private equity space, because some of these deals are really large and increasingly they are the market. And there have been questions about how do you outperform when you are the market? How much are you seeing actual performance, actual returns inherently go lower as you try to be safer and as you do invest in such big size?
The transaction we did for Baylor and XAI, double-digit amortizing transaction with the value of the chips being 0 in 5 years. That's good risk return for us. Again, I think that OpenAI is a unique company vis-a-vis some of the others because of the strong cash flow and balance sheet those companies have inherently versus the growth initiatives of OpenAI. But, certainly it's going to be a very large question. And I think that around the globe, more and more investors, because of the pension challenges, they're looking for long duration yield. That's a bit different than we've had historically in the last 10 or 15 years. So I think there is plenty of demand to be a scale solution provider. I think the other big question will be how many of these companies actually are able to hit the equity market, and what will the equity calendar really absorb over the course of the next year?
Do you think that stay private story is coming to a close? These companies have got to go public?
I do think that with the VC and private equity overhang, there is a greater demand for liquidity from a variety of investors, whether it's endowments or foundations that are knocking at that door. So I think there's no doubt there's an ability to stay private a lot longer, but depending on your constituents, employees, and others who might need liquidity, that's a challenge you're going to have to confront.
Jim, good to see you.
Always good to be here.
Thanks for being here, sir. Jim Zalter, Apollo Global Management President, breaking down capital markets worldwide. So we need the 10-year bond yield, the price of crude, and the return on investment of some of these big investments made in the last few years.
Yeah, there are a lot of what ifs, which is the reason why I think a lot of people feel paralyzed. But if you're going to be an optimist, and I'm not one, but if you are going to be an optimist, you could say the fact that people are so skeptical and looking at all the potential tails might give you hope that maybe we could avoid some of them, given the fact that people at least are having an eye of skepticism.
I hope so.
Yeah.
You seem cheery at least.
I am
First
cheery.
few weeks at 26.
Yeah. Pessimistic with a smile.
See if it lasts. Coming up on the programme, sounds deadly, like a Bond villain. Mira Pandit at JP Morgan's going to join us as investors await a double dose of employment data. Plus, Danny's going to drop by with your morning movers. Live from New York City this morning, the opening bell about 2 hours away. Equity futures pulling back by 0.2% on the S&P 500, pulling back from all-time highs in yesterday's session and adding to the move so far this morning. On the Nasdaq, we're down by a quarter. On the Russell, we're down by 0.4. Switch to the board and get to the bond market. 2s, 10s, 30s. This yield curve very much in focus going into the data of the next 24 hours. Jobless claims 60 minutes away. Then tomorrow, the payrolls report just around the corner.
Yeah, and I'm curious about what kind of response there will be in markets if you get a better than expected payrolls report, given the fact that we've gotten a number of data points on the labor market that have been a little bit more positive. What do you do with that? Does that mean that the Fed doesn't have to cut rates? Is that a negative? Or is this a positive when this sort of low hire, low fire kind of economy that's grinding forward at stall's pace, but albeit not falling off a cliff?
Challenger job cuts, not as bad. ADP just about okay. ISM services, pretty solid. What does it mean for the Duffs on the committee? We'll speak to one in about 30 minutes' time. Governor Stephen Myron pushing for some big interest rate cuts at the Federal Reserve. Does that case get less credible when you start to see that bounce back in the data?
Yeah, and watch wages, too. I mean, not just the unemployment rate, but also wages at a time when there really is a question. If there is all this fiscal stimulus, how does it pour through into the economy? Also curious to me, if the labor market is doing so much better, Why did equal weight underperform so significantly yesterday? Equal weight actually had the worst performance going back to the end of last year. So you look at all of this, you put it together, it's a mush. It's really confusing. What does the Fed do with that?
It's a pretty interesting start to the year, isn't it?
It is a fascinating
It really is. We've seen some big moves in the equity market, home builders, defense contractors, Blackstone. Danny's going to pick a few of those themes out. She joins us now for more. Hey, Danny.
Yeah, John, I'm starting with those defense names because those are the ones that are still actively moving. We've seen a little bit of ebbing in action from Blackstone and some of the housing stocks. They're all rallying today, and that's because we wake up to a different message from the president than we did at the close yesterday. Before the markets closed yesterday, he had issued this new order, a freeze on buybacks, a freeze on a lot of corporate action, including pay for executives until a lot of these defense companies can figure out how to ramp up production. And then after the market closed, he said that he wants to increase the defense budget massively by about like 50%. So then you get a rally from RTX, Lockheed Martin, Northrop Grumman up as much as 8.5%. Elsewhere, we did have some earnings from Applied Digital. Those shares up 4.3%. It's a company involved in the AI infrastructure build out. So you can guess why they did well. It's all about the AI exposure. In fact, their revenue was 250% higher than at this time last year. So a huge boom for them. Switching to commodities, Alcoa, that gets a downgrade from JP Morgan to underweight, saying that their preference is copper over aluminum. Makes sense given the record rally that we've seen in copper, and just saying that these shares don't present relative value anymore, so they are down 3.6% in the pre-market, John.
Danny, thank you. Thanks for that. More from Danny in the next hour. On our radar this morning, President Trump saying, quote, only time will tell how long the U.S. will maintain oversight of Venezuela. The president telling the New York Times the situation could last years and the country will be rebuilt in a profitable way. Elsewhere, the president also moving to ban institutional investors from buying single-family homes, saying in a post on social media, people live in homes, not corporations. It's part of the White House's plan to address housing affordability ahead of the midterms. And finally, more than 1,000 corporate entities joining the legal fight against the president's sweeping global tariffs. Costco, Goodyear, among those suing for refunds. The Supreme Court is considering the legality of the levies and could release a decision as early as tomorrow.
This just highlights how messy it'll be should the Supreme Court overturn the use of IEEPA to put on tariffs in this manner. It's clear that a lot of these companies are not making necessarily a political statement as much as they are trying to get their ducks in order for them to ask for refunds as soon as this is overturned, if it is overturned. And it highlights how much remains uncertain in this environment. I mean, we've moved on from tariffs, but that hasn't necessarily really left the page.
If the Supreme Court comes out and says IEEPA is illegal, it doesn't automatically mean you get your refunds. To your point of these companies getting their ducks in a row, you actually have to sue, and this will be handled mostly by the lower courts. You have to sue in order to get your money back, which is why we're likely going to see a lot more companies take legal action when it comes to the U.S. Court of International Trade, because if you don't put that legal action into effect, you might not get your refund.
A lot of the market's moved on. They feel like this is last year's news. This is all done. And for that reason, you've got people telling you, Lisa, that maybe even if we get that decision that goes against the administration, you're not going to see much price action in response.
This is the reason why I'm a little bit concerned that maybe they've moved on a little bit too quickly. The budget deficit. I know people are going to say, why are you so focused on the budget deficit? But the part of the issue, it is true. That's what a lot of people are saying. But we saw the market trade in that way, that this was viewed as a positive because it was going to stave off some of that budget deficit. Well, how much does that further expand the deficit if this is overturned?
And I also feel like I just keep beating a dead horse, but it has to be said, if IEEPA is overturned, they will still enact tariffs. It will just be legal avenues that then we can go into. Some of them never even used before, the 122, but they have a list. The administration obviously has been working on this. They have a list that they can use. They just don't want to use it because it's much easier to have the blunt use of IEEPA.
Lisa's right to keep turning to the bond market, though. If you look across fixed income, the global fixed income universe, and just take a look at sovereigns, developed market sovereigns, the 10-year Treasury was an outlier. Everything else was soft, yields and up. The 10-year Treasury yield was down, and there's a lot of questions as to why, and I think many factors behind that move, but one of them is the tariff revenue and the perceived benefit that was going to provide to the Treasury market.
Yeah, and if you think about what other provisions they could put on, where is the political will in a midterm election year to put on some of those extra tariffs? even if it does help the deficit, because you aren't seeing the bond market freak out. So right now, at what point does the bond market have to wake up to this idea of budget deficits once again? Well, it'll take more than what we've evidently just seen, because right now it seems pretty sleepy.
Maybe $500-600 billion of defense spending might move the Dow.
It might, but I don't know that it has.
If it can get through Congress.
If it can get through Congress. We've got more data later on this morning. Let's turn to the economy. The labour market data on deck with jobless claims due in about an hour from now. Payrolls due tomorrow, of course. Mira Pandit of JP Morgan Asset Management expecting jobs to grow by roughly 50,000 per month, noting a, quote, tenuous equilibrium between low demand and low supply to keep unemployment rate low. Mira joins us now for more. Mira, good morning.
Good morning.
That's kind of good news because the unemployment rate has been drifting higher. Do you think we're going to stabilise around these levels?
I think we can see some degree of stabilization because you do have this very low labour demand. And when you look at labour demand and payrolls in isolation, it looks like this is the type of chart that we're going into recession. But the reality is when you pair that with the low supply dynamics that we've been seeing, the most important number there is that unemployment rate, because if these low supply, low demand dynamics can stay in check, admittedly in a tenuous equilibrium that we can't exist in forever, but if for now they can remain in check, then overall that's a good sign for the labor market that it's frozen but not melting down.
What does this do for markets? I mean, it's one thing to have confusion around the actual data. It's another to figure out how markets treat this sort of low fire, low hire dynamic. Is it just sort of ignore, move on?
For now, it seems like the markets are more focused on inflation. And certainly, if you look at the Fed, I mean, I think there's a lot of calls for the Fed to cut up rates a little bit more, given some of this weakening in the labor market dynamic. But look no further than the Fed's December SEP. You have 2.3% growth. You have unemployment stable, a little bit lower than it is today. And you have inflation not reaching 2.0% until 2028. In that environment, do we really require cuts? And when we think about, especially considering some of this housing news coming out, when we think about the benefit to consumers and businesses of cutting rates further, I'm a little bit stymied here because if you think about the consumer, affordability is still the challenge. Inflation is still the challenge. Cutting rates has not been effective so far in bringing mortgage rates down a whole lot. And then you look at businesses. I look at that NFIB small business survey. Their number one problem is still quality of labor. It's finding the right people. Cost of labor ranks at number 7. By the way, inflation is number 2, so clearly still on businesses' minds. And then you look at things like interest rates, that's dead last. So I'm not getting from consumers or businesses that rate cuts are what they're demanding.
What they should do and what they will do, two different things. And right now, the market is pricing in at least 2, if not 3 rate cuts through the remainder of this year. Barring any balance sheet move, do you think that that will cause the 10-year yield to, all things being equal, rise, not fall?
Well, we have some competing factors here. If you're in an environment this year where growth is hot, and we do think it's going to be a hot, then cold and K-shaped type of economy in 2026, then that puts some upward pressure on the 10-year. If you think about inflation still remaining a bit sticky, and we know that right now some of that shelter component is likely to be underrepresented until probably April beyond, then that also potentially creates some upward levers on the overall 10-year. So there is a little bit of a floor that is created here just simply by the economic situation, not to mention the tariff implications that you've mentioned. And then more broadly, you think about debt, deficits, Fed credibility, Fed independence, and all of these things, to my mind, bias yields slightly higher than where they are today.
How much higher?
Not too much. I would say that the range that we're expecting for the 10-year this year is somewhere between 4 and 4.5. So we're roughly in the middle of that. So I don't think we're going to see a huge spike, barring a spike in inflation. But our expectations for inflation are that it will peak around 3.6% by June. So we're still looking at lifts from tariffs, lifts from perhaps more consumer spending coming out of some of those tax refunds, but then starting to fade out, especially when we think about base effects in the back half of the year.
When you say lifts from tariffs, do you mean corporations passing on some of the tariff impact, or we were all just talking about moments ago and basically this question mark regarding IEEPA? And to Jonathan's point, it felt like the market has moved past tariffs, but we have a huge decision potentially coming out tomorrow.
As Chair Powell said, you're going to start to see the impacts of tariffs, not all at once, but it will be a one-time type of event. So I still do think, and I agree with what you were saying, there are going to be some form of tariffs. They may not look like what they look like today, but they will be there, and we will continue to see impacts not only to companies, but also to consumers as they pass some of that on. And you look at things like core goods, you look at things like food, you do see not a surge, but you do see modest increases there. And this additional uncertainty, if there's new scaffolding around what those tariffs are, is going to create some mix up in terms of how that composition of inflation looks and how companies do need to adapt their supply chains to adapt to a new reality around
Let's
tariffs.
talk about the equity of those companies. Fold it into the stock market. Is this a year for the 493 or the big 7?
It's still a year for AI. It's less about the Mag 7 and the 493. I think the Mag 7 slowly will become a fading concept, especially when you look at performance. You've seen that in 2023, every Mag 7 blew out the S&P 500. In 2024, 6 of them did. Last year, only 2 did, and that magnitude of outperformance was much smaller. And you saw that broadening out to other sectors. You had double-digit earnings growth, not just in tech, but in industrials, materials, utilities in the most recent quarter. And if you put that together with financials, perhaps non-AI trade, you had 18 of the best performing 50 companies in the S&P 500, kind of neck and neck with the tech sector. So you're seeing that broadening out. I do think for the most part that is still AI linked if you look underneath some of these sectors. Outside of financials, that is one reason I really like financials, because it is sort of your counterweight to that when you think about favorable macro backdrop, steepening yield curve, potentially more deregulation, or at least the passive deregulation that we're seeing right now that's been beneficial.
Bank earnings coming up next week. Not too far away, are they? JP Morgan coming up next week, and the rest of them as well.
That'll be really important to see exactly how much of this M&A and IPO boom really does come to fruition, and whether the yield curve steepening is a very positive thing for some of these banks as they consolidate market share.
Mira, good to see you. Thanks for dropping by. Mira Pandit there of JP Morgan Asset Management. Let's give you an update on stories worldwide with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Minneapolis public schools are closed for the rest of the week following the fatal shooting of a U.S. citizen by an ICE agent yesterday. The 37-year-old woman was shot in what federal officials are calling an act of self-defense. It happened during what federal officials described as a targeted operation amid a broader immigration effort. Meanwhile, bankrupt auto parts maker First Brands Group warning it will run out of cash by the end of January without an immediate financing injection. The move could force the company to shut down some businesses and even sell other operations. First Brands is in talks with existing lenders to secure enough funding to continue operating and cover bankruptcy costs. And JP Morgan is taking over Apple's credit card business from Goldman Sachs. The transfer will occur in about 2 years and will boost Goldman's earnings per share by 46 cents in the fourth quarter. MasterCard will remain the payment network partner for the credit card. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. Appreciate it. Up next on the program, shutting out Wall Street.
Banning investors from putting capital into the housing market is not going to make affordability any better. This is a political narrative that is pushed forward for political purposes. It's not going to make any economic impact.
Up next, we'll catch up with John Navarro of UBS from New York City. You're watching Bloomberg TV. Futures negative by 0.2% on the S&P 500, pulling back on the Nasdaq 100 too. We're down about a third. Under surveillance this morning, the president looking to shut out Wall Street.
Banning investors from putting capital into the housing market is not going to make affordability any better. Large investors make for fun scapegoats during election years, but the hard truth is there are real families that might be affected by this. There's not some big loss to investors in the housing market. And this is a political narrative that is pushed forward for political purposes. It's not going to make any economic impact.
So here's the latest this morning. President Donald Trump announcing he will move to ban institutional investors from buying single-family homes in a push for housing affordability. Planning to address further details during his speech at the World Economic Forum in Davos later on this month. John Navarro of UBS writing, we expect minimal impact from the potential ban on institutional investor purchases. John joins us now for more. John, good morning and welcome.
John, thanks for having me.
Can we put some numbers on this? So politically popular, and we can deal with that separately. Let's talk about how economically effective it might be. Of all the housing stock at the moment, how much do these players own?
So, great headline, right? The big institutions crushing the small consumer.
At the end of the day, our builders have about low single digit to maybe mid single digit exposure to the institutional investors. Now think about this, the large institutional investors, the top 24, have about 3.5% share of the 15 million single family rental homes in the market. So they own less than, it's a fraction of 1% of the housing stock. And you know what? They've been net sellers. Think about Blackstone's been a net seller over the past decade. So while this is a great headline, it does very little to move the needle. We think there's a lot better ways to address this.
Before we get into some of the remedies and the other conditions, can we just talk about the Sun Belt in certain states? You went through some numbers. It's a very tiny proportion of the overall stock. But in certain states, how much more concentrated is it actually? In a place like Atlanta, Georgia, what kind of numbers are you talking about? Just give us an idea of things.
Yeah, I mean, it would certainly be higher than the 3.5%. What that exact number is, I'm not sure. However, what I can tell you is that, even in those markets, and these markets have seen some price realization and some changes that have occurred, inventory is there. So it's not a matter of, the institutional buyers soaking up all this inventory and raising prices. So it's really, in our opinion, just sort of a misguided approach.
That said, and before we get into the remedies, how negative does it look right now for home builders, given the fact that, as you were saying, there's been price realization? In other words, prices have come down, and you do have inventory really out there. Do they have any incentive to really create new product right now?
So may sound funny to you, but Lisa, we actually think that the building blocks are in place for 2026 to be a better year for housing. Now, let's think about that for a moment, right? Inventories have been stabilized or worked down in many of these key markets. Intent to buy is still very strong per our survey work. Mortgage rates are 100 basis points lower than they were at this point last year. Input cost inflation is moderating for the builders. Estimates have been cut by, call it 30% over the past year. And we're looking at valuations that are 9 times our 27 estimates. I mean, the blocks are in place for housing to be better in 2026.
It all keeps coming back to the mortgage rate, doesn't it? Isn't that sort of the key to unlock some of the affordability that people are talking about? What is the mortgage rate that truly changes the game after years of a mortgage rate that's north of 6%?
So there's not a great answer, but what I would tell you is that the builders have been buying down on average to around 5%, and that has seemed to unlock some demand. Now, does the existing home market need a 5 or a 5.5% rate to unleash demand? Probably not. I think a 5 handle would be very helpful. But we are down 100 basis points. I do expect to see an improving existing home market this year.
Is this all predicated, though, on the Fed cutting interest rates?
No, I don't think so. Look, here's one of getting into the remedies. One of the things that the government can do in the near term that can be very effective is leverage the GSEs, which are under conservatorship, right? They can have them subsidize mortgages, buy more MBS for their portfolios, and maybe most importantly, reduce G fees. I mean, guaranteed fees can add 60 basis points to a mortgage, right? And then this goes on top of perhaps even lowering tariffs. Tariffs are $9,000 per home.
The president has been flirting with this idea for months of creating a housing emergency, actually declaring one. What solutions would you expect out of that?
I think out of a housing emergency, the idea would be to try to pressure the states through withholding funding to reduce land restrictions. Now, the problem with this is that most of these decisions are made at a local and municipal level, right? And NIMBYism is pretty pronounced in a lot of these areas. Everyone talks about wanting low-income housing, but you know what? Just don't do it in my neighborhood.
You say your tariffs are $9,000 a home?
Yeah.
Where's that coming from?
So about 6,000 of that is from the reciprocal, the country's reciprocal tariffs. There's about 2,200 from lumber alone. And then there's, copper tariffs and other things. Now, what's interesting is that Trump has shown some willingness to negotiate on tariffs, right? We just had the recent pushback of the 232 tariffs on cabinets and vanities. I mean, it's a small chunk of the overall tariff bucket. But, there are some things that can be done there.
Do you think the home builders would pass that on if they got that carve out?
Look, I think in the near term, we need to see demand firm, right? Once demand starts...
Is that a no?
No, it's not a no. What it is I think in the near term, demand needs to firm. And like I said, rates have come down. If you think about the incentive loads or the percentage of the mortgage that home builders are buying down right now, it's high single digits, and in some cases up to 14%. That is very, very painful on a margin standpoint. So to the extent that they can pull back on these incentives, which we expect will happen over time, it's going to be a powerful lever.
Just taking a step back, one thing that we've talked a lot about on this program is that there is a real demographic shift and that younger generations and new people who have families really can't afford buying a home at this point and sometimes don't even want to because they prioritize other things, mobility among them, in their lives. How much does that affect what types of houses are being built? Do you notice a big demographic shift in terms of where the demand is coming from and where it isn't?
Interesting. I would say that the primary first-time buyer, let's pick on the millennials, have done things a little bit later in life. They're a better financed group, and they're reaching the period where they're getting married, they're having children, things that necessitate more space. Now, are they buying smaller footprint homes? For sure. Are they buying a little bit further away from the city centers? For sure. These are things that actually help the new construction market because you can't do that in the existing home market. And then importantly, on top of that, if you think about the National Association of Realtors Affordability Index, right now, anything over 100 is positive. Right now, we're at about 106. If you were to take the mortgage rate that they're using, which is 6.33%, and plug in that 5% that we were talking about, where the builders are buying down to, all of a sudden you get a number that's very, very close to the historical 30-year average of affordability, which is pretty good.
Just quickly, would you buy any of the weakness in the home builders in the last 24 hours?
Absolutely, yeah. We are decidedly bullish on the group heading into the year.
John, it's good to see you. Thank you, sir. John Navarro there of UBS on home builders, following a rocky 24 hours for that sector.
Yeah, you saw some pretty significant moves in some of the home builders because ultimately, even if it is the major buyer, the fringe buyer that has been a price setter could potentially not be as engaged should there be some sort of ban on institutions buying homes. Honestly, again, what will actually get passed versus the signaling is a huge question.
They are a political target into the midterms.
Yep, but to your point, the president is saying I need Congress to codify this. But I was also struck that Gavin Newsom, who's going to be giving an address this evening as well for California, did the same exact thing when it comes to homes in California. So this is politically a lot of appetite. You see it on the right and the left when it comes to voters. They want to see action because you're going after big bad Wall Street. It feels good, even though this is the president's friend and big donor. It feels good. But to Neil Dutta's point, it's just not going to work.
I know California's beautiful, but if you've got wealth in California right now,
you're leaving.
You are staring down the barrel of the next 12 months, 24 months in that state. What are you thinking?
Well, Jensen Huang didn't seem to mind in terms of the billionaire tax. Someone asked him about that. He's like, it's okay because he has like $500 billion. So, what is it?
It's a bad idea.
Yeah, exactly.
He's like in his leather, in his very expensive
alligator leather jacket.
When they say it's a good idea, the next question should be, are you going to write a check? Just write a check right now. Why are you waiting for the policy? They'll accept it.
Well, ask him. I think Jensen Huang, if you're listening, please write in. Will you write a check?
Governor Newsom will cash that donation.
I don't think it's a wrong question.
OK. Up next, we'll catch up with the Fed Governor Stephen Murray, Michael Gapin of Morgan Stanley here to react, and Nita Richardson of ADP.
The economy is kind of treading water.
Not a lot of hiring, a lot of caution. We've just been consistently trending higher in the unemployment rate.
Strength in the labor market, I think, eventually could cause some of that soft economic data to catch up.
The economy could grow even when we have a labor market that's not growing much at all.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures on the S&P 500 adding to yesterday's losses, pulling back just a touch on the S&P by 0.2%. Lots of data in our future, 8:30, 30 minutes away. Jobless claims, then tomorrow, the payrolls report. Payrolls Friday, we're looking for something around 70K. For the December jobs number.
Yeah, and that's been creeping higher, as you pointed out earlier, John, which I think is important given some of the other labor market indicators that have been relatively positive. Key question is, what does the market do with this, right? Is that considered a positive? Does that mean that the Fed isn't necessarily as incentivized to cut rates? Or does it not matter at all because we can't understand these numbers without also understanding the unemployment rate, where that is, as well as what the break-even rate is, which we also don't fully understand. So a lot of questions. Maybe we'll get some answers.
And to Mira's point, it could just be frozen because of supply and what's going on the immigration front, which is why the unemployment rate is so important. What is so interesting, though, about tomorrow is it's the first clean read in a while, given the fact that Washington decided to shut down for 43 days.
We always say that, and then people say, we've got to take this bit out, got to take that bit out, and this is what you should really be looking at.
I know, I'm a little loath to say this is clean because people will give you 14 reasons why it's not clean. I just sort of remember when you were lobbying for the Fed to push back their meeting to get the labor market report, to get CPI, and that would have not helped in any way because it was so messy and noisy that people just disregarded it entirely. It is a data-dependent market, but is it really? Because what does this data mean? I think that's increasingly what people are feeling.
The great tease for the data we'll get later this hour. And tomorrow, 8:30 Eastern Time for jobless claims today and for payrolls tomorrow morning. Coming up this hour, Fed Governor Stephen Murin on the path ahead for interest rates. Neela Richardson of ADP breaking down the latest jobs data. And Venu Krishna of Barclays expecting double-digit EPS growth this year. We begin this hour with investors searching for direction in a pivotal year potentially for the Federal Reserve. Fed Governor Stephen Murin doubling down on his dovish stance, calling for the central bank to cut interest rates by more than a percentage point in 2026. Governor Murin joins us now for more. Governor, good morning and Happy New Year.
Happy New Year. Thanks for having me back.
It's good to see you. You've been very, very transparent about where you are on the dot plot and what your forecast is. So let's start there. Where are you for this year? Where's your dot? What are you looking for?
Yeah, so I'm unsurprisingly the lowest dot. I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. I gave a speech about this about a month ago in December at Columbia University. My view is that almost all of the excess inflation over target is due to quirks of how we calculate inflation. So as you have talked about with many of your guests many times before, shelter inflation really lags a lot. And because average tenant rents have caught up to new tenant rents, because market rents have been running at a 1% rate for a couple of years now, I think it's appropriate to sort of think about underlying inflation as abstracting from that a little bit. The shelter inflation is indicative of a supply-demand imbalance from 2022, 2023, not 2027. We need to be making policy for 2027 because of policy lags. And the other side of it is the portfolio management fees that I'm sure you've talked about again with many of your guests many times. Stock market went up, mechanically inflation moves higher, despite many of your other guests, I'm sure no doubt, telling you about fee compression in the asset management industry for decades. So you abstract from those two things, underlying inflation is running at 2.3%. That's within noise of our target.
That sounds like an argument for neutral. You're making an argument, though, for this year, for accommodation. Where does that come from? Why are you looking for accommodative monetary policy stance coming out of Washington?
Yeah, so a couple things. First of all, as I just said, underlying inflation is running within noise of our target, and that's a good indication of where overall inflation is going to be going in the medium term. But then the unemployment rate is 4.6%, right? So that means that there's about 1 million Americans who don't have jobs, who could have jobs without causing unwanted inflation, without causing unwanted upward pressure on inflation. I don't think it's right to tell those people that they shouldn't have jobs because we're just mechanically calculating inflation in some silly way. I just don't think that makes a lot of sense. The other thing is that because we've kept policy tighter than I think it ought to be, that makes me mark down our growth forecast for the future relative to where it should be. And so if we hadn't been keeping policy, in my view, too tight over the last year or so, it wouldn't be necessary to provide that type of accommodation.
Just quickly, you say mark down in the future because the Fed actually marked up GDP for 26. Where do you mean in the future?
No, so like when you look at these dots, right, in the SEP, they're projections of appropriate policy and projections of economic fundamentals like growth and inflation, conditional upon appropriate policy. So my projections for growth and inflation are conditional upon getting my policy forecast. Right, my policy projection. If I don't get my policy projection because the rest of the committee is more hawkish than I am, then we wouldn't meet my growth and inflation projections, we'd underperform them. And so because policy has been, in my view, too tight for the last year, that means that my expectations of growth will ultimately be unsatisfied because we didn't get the policy that I wanted.
You have GDP 2.6% roughly over the next few years. Are you saying that the appropriate growth rate is something like that 2% and 2.6% and not necessarily 3% or above?
Well, so that's conditional upon getting the policy projection that I want, right? And I think and part of that is and part of the reason why it's a little bit lower than I think 2.8, 2.9 is probably more where it would be if we sort of had the right policy the entire time. Part of the reason it's a little bit lower than that is because we got to account for policy having been too tight over the last 12 months. Right.
There's also a question about the reaction function. We've been talking about the data that we're going to be getting tomorrow. What would you have to see to change your view? I mean, if we saw, let's say, the unemployment rate go down to 4.4%, would you start to question whether 150 basis points of cuts is really necessary this year?
That's a great question. And before I answer it, let me step back a foot and say that my forecast is conditional upon shelter inflation coming down. right? And there's people who agree with me, by the way. Like you look at the research from Goldman Sachs, it's pretty similar to where I am on shelter. They've got shelter inflation running below the pre-COVID rate by the end of the year, similar to where I have it. Where I differ from a lot of my colleagues, again, is thinking that goods inflation is not being driven by tariffs. I don't see tariffs being driven by goods inflation. I see goods inflation, I'm not sure what's driving it. I listed a few possibilities in the speech in December. I think the jury's still out on that one. But if I end up being right on inflation and on shelter, if I end up being right on shelter and Goldman ends up being right on shelter, and I end up being wrong on tariffs and everybody else is right on tariffs, then we're going to undershoot our target. Two-sided risk is back. And I think that people haven't really internalized that yet. And I think it's important to appreciate that. Now, where would I be wrong? Because so much of my disinflation forecast is based upon shelter. I'm going to be wrong if market rents pick up again.
So you're saying this is all an inflation issue and not anything to do with the labor market?
No, as I said before, unemployment is somewhat above where I view the natural rate. And so it's 60 basis points, 1 million people. Of unnecessary unemployment that we could reduce by having a more appropriate policy stance.
But to Lisa's point, is there a line in the sand on the unemployment rate tomorrow that would maybe have you think about this a little bit differently? What if the unemployment rate drops down 4.5% or even 4.4%?
Yeah, I would absolutely adjust my projection. So if you look at the September SEP, right, I was 50 basis points higher than I was in the December SEP. Part of the reason why I adjusted my dot down by 50 basis points is because the labor market didn't perform per my expectations that I had in September, and because inflation actually outperformed to the downside, right? So it was appropriate to adjust my dot down. And then on top of that, we had the two tight policies I described. So if the data come in a little bit better, yeah, of course I'm going to adjust my expectation.
In just the past few weeks, we've heard from a number of your colleagues talking about how actually they feel like we're pretty close to neutral. Have you made any inroads convincing them that they're not right about this? The way you see the world?
I can't speak for them, but I think that every month we come in and the unemployment rate ticks up a little bit, and the inflation data sort of seem to be doing a little bit better. I think it's really difficult to argue that policy is neutral, especially when we've been on this course of gradual loosening of the labor market for a couple of years now. It's just really difficult in my mind to sort of argue that policy is not restricting the economy.
A couple of words I want to pick out,
yeah.
And one is neutral and the other is correct. I think it's very difficult to say this is where I think neutral is and this should be the correct policy rate, because it's such a guessing game as to where neutral is, and I think you understand that, of course. I also want to pick up the difference between being an economist and being a policymaker. When you say two-way risk, I think that really makes us all think about speed and the appropriate speed to adjust monetary policy when there is two-sided risk. Why do you think we should be going this fast this year, in your mind, to cut that aggressively in 2026?
Sure. So same thing as I said in the last few times I've been here. We're still materially above neutral in my mind, and there's not really a reason to be materially above neutral if the labor market is on a weakening path and inflation is underlying inflation's already running close to our target and on trajectory to hit the target. There's just not a real reason to be so restrictive, and we're running unnecessary risks on the labor market by being so restrictive. And so in my mind, it's like we're selling options for nothing, and I don't see why we're selling those options for nothing.
This just requires such a strong amount of conviction, though. Coming out of the pandemic, I think what we all learned was a massive degree of humility, because there were so many things that we thought were obvious that actually things just turned out to be completely the opposite. And I wonder if this year we should have the same approach to monetary policy. As a monetary policy official, do you have to sit here and say, actually, the prudent way to do things is actually to move slowly and work things out meeting by meeting? Because that's what I hear from other members of the committee. And I'm wondering why you see things so differently.
Sure. So first of all, I'll say that I was right about inflation coming out of the pandemic. And if you sort of go back to 2020, when I was at the Treasury Department, we were arguing for a smaller stimulus package because we didn't see COVID as a similar type of recession that we had post-GFC, post-dot-com bubble, where you had persistent deleveraging dragging on demand that caused a balance sheet recession with a persistent, slow, crappy recovery, right? COVID was like a switch turned off. Right? People stayed home, and the switch turned on when they started going out again. And so there wasn't going to be that slow recovery. And that's why we were pushing for smaller stimulus packages, because we didn't think that it merited that type of package. We were concerned about inflation picking up. So I did get that right. And I do understand the value of being cautious and having humility in these things. I will say my forecast, as I said before, is predicated upon shelter inflation. And shelter is a weird thing where market rents give us a window into the path of measured inflation that's very different than other sections of the inflation index. We know that market rents, a weighted average of single-family, multifamily market rents, have been growing at a 1% rate for 2 years now. We know that average tenant rents have caught up to new tenant rents, right? There are are statistically mechanical relationships that give you a lot of confidence that measured shelter inflation is going to come down a lot, right? You don't have that type of confidence when you're talking about goods. I said before, I don't know what's driving goods inflation, right? I don't have this forecast that goods inflation is going to come down because it's just driven by tariffs that my colleagues seem to have, right? I don't have that type of confidence on areas of the index that I think are much more difficult to understand. Shelter is a mechanical thing from market rents to measured inflation, and therefore it's in my mind appropriate to have that high degree of confidence. And to Lisa's point, where would I be wrong? If the market rents pick up again. If the market rents pick up, then I'm going to say my mechanical pass-through from market rents into measured shelter inflation is getting invalidated, and we'll see that.
Just to hone in a little bit on the housing aspect, since that has been a really hot topic, how much signal would you take if you did start cutting more aggressively at the Federal Reserve and 10-year yields rose, and that actually created an issue for mortgage rates and the pass-through there? It might actually help with the disinflation, but it might not exactly be the outcome that you're looking for.
Yeah, so this is an area where I'd want to not jump to conclusions, because I'd want to sort of try and analyze it very carefully and think about what the market is saying, think about what the economy is doing. And if it's the case that you cut rates and you sort of get a burst of activity in some sector of the economy that's not housing, and that ends up crowding out housing, then you wouldn't really mind. You're focused on aggregates. You're focused on inflation, on aggregate inflation. You're focused on aggregate unemployment, right? If it looks like you cut rates and the bond market is giving you a very clear signal, and I'm not just talking about trading behavior for a week. I'm talking about a very clear signal over the course of a period of time that it's not the right move. Then I think, you want to take that signal and you want to think about, what's the market telling me that I missed? Is the market right? Am I wrong? Let me rethink my framework.
You're going to miss this when it's all over. It feels like you're enjoying this. Are you going to miss this when you have to leave the Federal Reserve?
That's not part of my forecast.
Are you going to hang around?
Oh, I have no idea. We'll see. I don't make personnel decisions.
Okay. You've heard nothing at all from anybody?
I think that we're very clearly now getting into the new year, and the president has said in the past that he would make announcements as we got there. So,
okay.
I imagine we'll be getting some at some point, but I don't know anything about my future, so I wouldn't mind it.
What a position to be in. We're all sitting here waiting, just like you. Governor, thank you. It's good to see you.
Thanks for having me.
Thanks for being so generous with your time. The Federal Reserve Governor there, Stephen Myron. Let's give you an update on stories worldwide this morning with your Bloomberg brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Donald Trump saying he will request a more than 50% increase in next year's military budget to $1.5 trillion. The president also calling for military contractors to cut dividends and buybacks. He also called out RTX specifically, threatening to stop doing business with the missile maker unless it invests more in its production capabilities. And Chevron shares are edging higher. On our reporting, the company's in talks with U.S. officials over extending its license to operate in Venezuela. The oil major currently produces and exports Venezuelan crude under a special license that exempts it from U.S. sanctions. The talks coming as President Trump prepares to meet with oil executives at the White House tomorrow. And China plans to approve some imports of Nvidia H200 chips as soon as this quarter. Sources telling us here at Bloomberg, Chinese companies will be allowed to purchase the chips for select commercial use. The H200 will be barred from the military, sensitive government agencies, critical infrastructure, and state-owned enterprises due to security concerns. That's your Bloomberg brief. John?
Yahara, thank you. Thanks for the update. Up next on the programme, the Morning Calls Plus. Mike Gapen of Morgan Stanley joins us, expecting the jobs data to pave the way for a January rate cut. That conversation just around the corner.
You have to be very, very careful about how you invest long-term at scale. You can have some bumps in the road during the course of the year that definitely change the trajectory on liquidity, on momentum, on risk appetite. But I think the long-term trend is quite positive. but I do think you have to be very measured about how you execute your business model.
Fantastic lineup of guests so far this morning, right here on Bloomberg Surveillance. That was the Apollo Global Management President, Jim Zelter, joining us a little bit earlier on this morning. If you are just joining us now, welcome to the program. Equity futures shaping up as follows on the S&P 500, negative by about 0.1%. That's the price action. Here are some morning calls. First up, Piper Sandler lowering its price target on Chevron to 174, noting a bearish crude outlook weighing on the entire sector. Elsewhere, Citi cutting its price target on Lennar to 113, preferring exposure to heavy construction materials over residential. Their stock's down by about 0.1%. And finally, Barclays raising its target on Vail to 1550, seeing upside risk to precious metals due to expectations for further Fed easing. Vale?
I think it's Vale. I've gotten that wrong before and people laugh at me.
Vale.
Yeah.
We're down about 1.9% on that stock. Let's get back to the Federal Reserve. Let's stick with the Fed, doubling down on a dovish outlook.
I'm unsurprisingly the lowest dot. I'm looking for about 1.5 points of cuts. A lot of that is driven by my view of inflation. I gave a speech about this about a month ago in December at Columbia University. My view is that almost all of the excess inflation over target is due to quirks of how we calculate inflation.
Fed Governor Stephen Myron calling for the central bank to cut interest rates by more than a percentage point in 2026. Michael Gapin of Morgan Stanley expecting the jobs data to pave the way for an interest rate cut later on this month. Michael joins us now for more. Mike, good morning. Good to see you.
Good morning.
What did you think of that interview with Governor Myron? His argument, not just to go once, but to go quite a few more times in 2026 for the year ahead.
Right. Well, I think there's two paths, I think, for Fed rate cuts. One is, I think, as you noted in the lead, that while firms are continuing to pass through tariffs, which should extend into 2026, the hiring rate is likely to remain low, and the risk is the unemployment rate continues to trend higher. If that happens, the Fed may put in more rate cuts to support the labor market. If that doesn't happen, so say the December report tomorrow is a 4.5, or as you noted, maybe even a 4.4 unemployment rate, and looks like hiring is stabilized, the next path to rate cuts is triggered by inflation. Does inflation settle down in the second half of the year so further normalization is warranted? So I do think that there's multiple paths for cuts in 2026. I'm not convinced we need more than 100 basis points of cuts, but I think you could make the case that 1 to 2 more rate cuts, 2 more rate cuts in 2026 is warranted. They could come early if the labor market is soft. They could come later if it's about inflation.
Well, let's start with this month. Much harder to predict that may be than the next 12. The jobs number on Friday, so 70K is the estimate for the headline payrolls number. The unemployment rate expected to come down just a bit to 4.5%. What's a bad number on Friday? What gets the decision at the end of the month of the Federal Reserve done?
I think you need, what I'll call a solid 4.6. So it needs to be 4.6 something. It doesn't need to round up to 4.6. I think it has to be 4.6 or above to tell the Fed that the path for the unemployment rate is still higher, and in contrast to their expectations that it should drift down. And I think to your point, we all want the data to be clean. So it would have to be a clean reading, right? What I think consensus is saying, and there's a legitimate case for this, is that there was a large number of unemployed on temporary layoff in November. If that reverses entirely in December, it could bias the number down, and you could end up with a 4.5 or below. If that's the case, the Fed's likely not cutting at the end of the month. So if it's a clean reading on 4.6 or above, like 4.625, for example, or something, that would tell the Fed the direction is still higher. Maybe you should front load some of your cuts, and that would open the door to January.
We're talking entirely about the labor market, and Governor Myron didn't seem to be concerned about inflation in any way, and yet we're still talking about a dual mandate very much in conflict. Mm-hmm. Do you think, from an economic perspective, that the dual mandate isn't quite as in conflict as it was, say, 2 months ago, that now it is the labor market that needs to be prioritized at the expense of inflation that still is above 2%?
On balance, yes, because I think the majority of the inflation data paints a picture of tariffs are pushing goods prices higher, but fairly modestly. We think maybe they've pushed up inflation by, say, about 50 basis points. There's maybe another 20 to 25 to go. So the tariff pass-through is about in line with expectations. There doesn't seem to be a lot of upside risk to that. It's happening, but it's not out of line per se. And then the rest of inflation is consistent with something at 2% or a little bit above. in 2026. So I think the inflation data has given them comfort that, okay, it's moving higher, but it should start to diminish after pass-through is complete. So in the second half of 2026, it should come down. Based on that, the dual mandate is a little more in balance.
I'm just wondering how housing fits into this, given the fact that there seems to be such a focus on that, how much the Fed is going to be focused on this as an issue and getting long-term rates lower, which is not necessarily a call for lowering front-end rates. I know this sounds like, why are they dealing with bond market math? But at the same time, people have almost been judging them. And this president has been judging them on housing affordability as much as anything else.
Well, it's housing is a difficult story. There's a lot going on in housing, and I don't think there are really many easy answers. It's the combination of years of underbuilding, lack of supply, and a mortgage rate that's still hundreds of basis points above the effective mortgage rate. And home prices are up roughly 70% or so over 5 years. So that's going to be difficult to reverse. The answer for housing, it's not palatable for politicians, but I think it's true, is time. It's just time.
Well, we're on a November clock.
Yes, I understand. They're on a different clock than we are. But the lockup nature of the housing market has slowed down rates of transactions in a way that will mean it just will take years to work out. I think that's just truth.
Neil Dutta did, though, talk about in a note about mortgage-backed securities and how the Fed speaks about them. Is that one way the Fed could remedy this problem?
In terms of, say, purchasing mortgage-backed securities? Yes, but then you're back to honest QE, right? What they're doing in T-bills, they're characterizing as something different, front-end interest rate control. I agree with that. But if you start buying longer duration instruments, it's a different story.
As we reflect on that conversation we had with the Federal Reserve Governor 10, 15 minutes ago, I thought the end of the conversation was really revealing. You've got someone who sits at the Federal Reserve, has got a family, and has got no idea what his job is going to be next month because no one said anything about who's going to replace him at the Federal Reserve.
Yeah, it's right now a very difficult situation, I'm sure, for everyone on the Fed because they don't know who the leader is going to be. They don't even have a full understanding of what the composition of the Federal Reserve governing board will be like come the end of next year.
We don't even know if Powell for sure is going to give up his governor seat, even though we know obviously he's no longer going to be chair. But Stephen Myron, first revealing, though, he did say that's not in my forecast. So it does sound like he wants to stay past January 31st when his term is up.
But just to appreciate, as we forecast the year ahead, we've got no idea what leadership looks like in the second half of the year.
Even people at the Fed currently have no idea about the leadership.
People are saying, it's going to be Kevin. Kevin who, I don't know, but it could be someone else at this point too.
Could be someone.
Could be a Scott. Could be a Chris.
Exactly.
Could be a Rick.
Yeah.
Could be a Mike. Michael Gapen of Morgan Stanley. It's good to see you. Thank you.
Thank you.
Up next on the programme, the latest jobless claims. We'll catch up with Nita Richardson of ADP. Cash opens about 60 minutes away. We've got some jobs data in about 20 seconds' time. Jobless claims just around the corner. The scores into that data shaping up as follows. Equity futures on the S&P down by 0.1%. Similar move on the Nasdaq. In the bond market, switch at the board anchored around 4 to 420 on a 10-year maturity for the last 4 months or so. There we are in between that range at the moment, 416.13. And the front end of the curve anchored around a very noisy Fed, but a Fed that's not going to do much over the course of the next few months based on what we've heard from a number of people. 346.96 is where the 2-year is right now. Let's get you some data. Let's cross over to Mike McKee for more. Good morning, Mike.
Peak estimate 212K.
Well, John, it looks like we have our last clue before the payrolls report tomorrow. 208,000 jobs for unemployment claims filings. That's up from 199 was the initial report. That's been revised up to 200,000 for the prior week. Now, remember, these are pretty low numbers, but we also had the last 2 weeks be holiday weeks. So we could see a jump up in the weeks after that. This does come after the Challenger job cuts this morning, released early than as expected by Challenger, down 8.3%, basically halving the number of job cut announcements in December and the lowest since July of last year. So it does look like the labor market is just kind of hanging in there at this point. We also get the trade balance, negative $29.4 billion. That's a shockingly low number. The forecast was for 58.7, and that should do some good in in terms of pushing up the revised third quarter growth numbers when we get them. Exports were up 2.6%, imports down 3.2%. There's the reason we are not importing anything. A lot of imports going sideways because of the tariffs, no doubt. And finally, we get productivity, the first read on productivity for the third quarter, 4.9%, just a tick lower than anticipated. And it is up from 3.3% in the second quarter. Unit labor costs fall by almost 2%, 1.9%. They were up 1% in the second quarter. And this is important because if companies can get this kind of productivity, they don't necessarily need to hire. Remember, we had very strong growth in the most recent quarter, and it is a result of not adding a lot of people, but adding a lot of some sort of capital for productivity. And if that continues, then maybe we see companies still holding off on hiring while they wait to see what the Trump economic policies are going to be.
Well, Mike, let's talk about the policy. Now, the following question highly dependent on the president's objective, but ultimately, is his policy working?
Well, that depends on what his policy actually is, and I am not really joking about that. I'm trying to be serious in the sense that if the president's goal is to bring down the trade deficit, he's done that. It's the smallest since 2016, but that's basically irrelevant to the overall economy and isn't really going to make anybody's lives a little better. The productivity numbers are good. That's probably from AI, so I don't know that that has a lot to do with him. And the jobless numbers, the payroll numbers that we're seeing are more a result of his policies and uncertainty about what's going to happen going forward as companies wait for further information. So it doesn't look like he's making a lot of progress, although if productivity were to continue at these levels, we would see it be disinflationary, and that might get him back on the affordability track.
Mike McKee, thank you. Mike, down in Washington, D.C., the smallest trade balance in quite a while in the United States. And I think for the president, he's going to point to that as a success.
Yeah, the smallest going back to 2009. Pretty shocking to see that. You can look into the numbers and get more details, but this really does highlight how exports are increasing and imports are decreasing, just as the policy kind of was prescribing.
He's drafting the Truth Social post right now that this policy is working. When they go into, at least what I've heard, when they go into these meetings with trade partners and want to discuss tariffs and trade deals, the top of the page shows the trade deficit these countries have with the United States. And that is what is a key driver in the president when he thinks about when he is enacting policy. To Mike's point, some of the policy at some points can be confusing, but he cares about this deeply.
Whether it's a success or not is highly dependent on his objective. His objective was to get that number down, and that's what he's got. To your point, exports up and imports absolutely cratering. Got to talk about the jobs market too. Want to see more of this. Claims around 200K, starting to see a bit of a bounce in the data in the last week or so, and hopefully we see the same thing tomorrow morning.
Yeah, to me, the fact that the previous week of data was also revised just minimally, almost the same level as what it was before, at 200,000 versus 199,000, people saying maybe that was a messy read, that it wasn't actually that low. It was actually that low. It raises this question of, is this a healthy market, or is this a stagnating labor market where, yeah, people are not being laid off, but they're also not being hired? Right now, the data that we've gotten so far this week points to actually a slight pickup in the labor market. Do we see confirmation of that tomorrow?
Let's hope that's going to be the case. Nita Richardson of ADP joins us now for more. Nita, welcome and Happy New Year. Good to see you.
It's great to be here.
We'll park the trade story. Let's focus on jobs. Are we going to see a bounce tomorrow morning?
I think so, but it's going to be a highly concentrated bounce. It's going to be focused on healthcare and leisure hospitality. And the thing about that is that it underlines this K-shaped economy, right? Healthcare and health services are expensive for most consumers, and leisure and hospitality is discretionary for all consumers. And so where we're getting strength is reflective of this K-shaped spending pattern.
Are we going to see that through the rest of the year? Can the status quo persist? Because we've seen this for quite a while.
We have a really strong demographic tailwind for healthcare services in this country. The dynamics of an older population certainly suggest that we'll keep seeing hiring. But this is where things get tricky. Because sometimes when we don't see hiring, and I think this is true in construction, for example, it's because there's not the workers there. This has been a very choppy labor market. The overall labor market is very jagged in terms of its patterns. And I think where market watchers go wrong is they spend too much time looking at the headline number and not enough time unpacking what's underneath. Because what's underneath is where all the action is in terms of the future of the jobs market.
So what's happening underneath the numbers of manufacturing in particular, and not just in construction, but more broadly, because that has been the laggard. That has consistently been in recessionary territory and contraction territory when it comes to employment, when it comes to actual numbers. And at the same time, you're seeing services continue to pick up. What does that look like under the hood?
It's part of where the economy is going. We are a service-oriented economy, and the tariff policy to date hasn't produced consistent job growth in that sector. Now, we did see a bounce actually in the ADP numbers in earlier in 2025, but that bounce wasn't sustained because there are other headwinds in that sector that needs to be addressed. So for this December report, we saw a loss in the goods sector of 3,000 jobs, only a 1,000 pickup in construction, 5,000 loss in manufacturing, but that's not new. That's just a trend that has been continued since even during the great expansion we had from 2010 to 2019. This is not a new trend. So what shakes up that trend? I'm not sure right now, but we're not seeing it.
Well, I guess the reason why I point to that in particular is because we hear all these companies that are building out infrastructure, that are investing in the physical world once again. We talk about bringing manufacturing back to the United States. Why are we not seeing that in the numbers? Even at a time when the trade deficit, as we just saw, did shrink to the lowest since 2009.
Well, I think the answer that we've seen to date is productivity gains, but I'm going to suggest that's only half of the equation, because if you want real growth in any sector, you need two things. You need productivity and you need people. Both of them lead to sustained growth over the long term. So how do we get those productivity in the hands of the workers so that we can maximize output? AI has the potential to do that, but I think it's going to take a little more time.
Do we have enough supply?
Of workers?
Yeah.
In some areas, we have too much. In some areas, we don't have enough. Healthcare, I don't think we have enough workers. Care economy, not enough workers. Construction, not enough workers. There are accountant services. In fact, any place where you see an infrastructure, whether it's physical, the care economy, or financial, when it comes to accountants, there's not enough people. And I think that's a different question than are we in a cyclical downturn? It's really about a structural future where the labor market has changed dramatically.
Well, I was going to ask you, where does this all leave the Fed? But I think the more pertinent question would be then, how do you solve for this kind of mismatch?
That's the important question, because the Fed acts short term. I don't think there's any disagreement about that. They are poised to address cyclical short-term factors in the economy. They are not poised to address the structural change that we know is coming with AI, with demographics, and with this long-standing shortage in key areas of the economy. And that is really what's going to sustain the U.S. over the long term.
Do you think that's lulling them into some kind of policy mistake? Through no fault of their own, just that they're trying to address something that is unfixable?
I think the why matters more. Usually you see a jobs number, and I say usually, over the last 20 years, you see a jobs number. It's either good or bad. Now you see a jobs number, and you got to ask yourself why. Why is it low? Is it low because firms are, feeling good about the productivity they're seeing in the future and they don't need to hire? Is it low because of immigration and they can't find the workers? Is it low because they're not seeing the consumer demand that they used to see? We need to know why, not just the number. And that's the place where the Fed is right now. They have to unpack the why in a way that they didn't maybe during the Great Expansion. And so, it makes policy trickier.
Nita, it's good to see you, as always. Thank you. Nita Richardson there of ADP on the labour market. To Nita's point, typically we'd have a bias. We'd sit around the table, we'd see any given jobs number and be like, yep, there's a cyclical read here, up or down, good or bad. Things are different this time. Things have changed a lot.
And this is something the Fed has acknowledged. They've said ultimately there are a lot of questions. We don't know how much is AI related. So far, they're viewing the potential adoption of new technology as being highly disruptive in the economy, which is why they want to run it a little bit hotter so that they can allow people to keep getting jobs. That is a thesis that is driving a lot of Fed policy, and I do wonder how much that's going to bias them to cut rates more aggressively.
We need to define the they as well, because this year I've got no idea who they actually is.
I get the sense.
Still don't know the Fed chair is.
Yeah, they don't have an idea who they is.
I'm surprised by that. we torched the Biden administration again on this issue. They were so slow nominating a new Fed chair, at least confirming Powell to a second term for a whole bunch of reasons, and I thought it was silly at the time. I'm surprised how long this is taking to select a new Fed chair for the next few years.
Especially because it's not as if it's not a talked about issue at the White House. It's not as if this issue hasn't gotten a lot of playing time. So that's really the issue to me is, what is it being used for? If it's being publicized as a controversial, we're going to do it, we're going to do it, we're going to do it. I mean, what is the sort of meaning behind why it's taken so long?
I think it's twofold. One, they do like that the Fed obviously has cut 3 times last year, so there was no rush. But now I think it's because the president has not gotten a yes from his number one choice, and that's the Treasury Secretary. And I think until he really feels good about who he is going to put in that seat, he is not going to say, he's not going to announce it. He's still, I think, trying to convince someone to take a different job.
That's the latest on the Federal Reserve and the jobs data. More jobs data tomorrow. Payrolls just around the corner, 8:30 Eastern Time tomorrow morning. Let's get you an update on stories worldwide this morning with your Bloomberg brief. Back with us, here's Yahara for more. Hey, Yahara.
Hi, John. Recapping the latest unemployment data. Initial jobless claims for last week coming in at 208,000. That is up from 9,000 from the previous week, but still 4,000 below estimates. Continuing claims came in at 56,000, and that was above estimates. Meanwhile, President Donald Trump saying he'll ban institutional investors from buying single-family homes. The president's posting on Truth Social, people live in homes, not corporations, and saying he would talk more about the issue at the World Economic Forum in Davos later this month. And prices in the secondary market for luxury watches rose to the highest in more than 2 years. The Bloomberg Subdial Watch Index gained 8% in 2025, with dress watches and smaller jewelry style pieces gaining ground. Gen Z collectors are seeking more unique watches over the once dominant blocky sports models. That's your Bloomberg brief, John.
I'm pleased we got over that. It was an important thing to get over and move on from.
Well, I kind of like those.
Those big bulky watches?
Yeah, I kind of like them. I think that they're really appealing.
I love the elegant ones that look like a bracelet.
I want the ones that look like,
Lisa's just, just wants an argument.
Yeah.
She doesn't even wear it. She doesn't even wear it.
All right, okay, let's,
This is what happens at House of Bramo. Winds up the kids, throws a grenade, walks away.
Stop projecting, John.
Yeah. It's a my times too.
Yeah.
All the time. Up next on the programme, Venu Krishna of Barclays expecting double-digit earnings growth this year. Plus, Yahara is back with your morning movers with Soho House shares sliding as it faces a funding gap for its merger. I'd be told to behave all the time when I was a kid, and my dad would turn around to my sisters and say, "It's good for you. It's good for you." From New York City, you're watching Bloomberg TV.
My projections for growth and inflation are conditional upon getting my policy forecast, right? My policy projection. If I don't get my policy projection because the rest of the committee is more hawkish than I am, then we wouldn't meet my growth and inflation projections. We'd underperform them. And so because policy has been, in my view, too tight for the last year, that means that my expectations of growth will ultimately be unsatisfied because we didn't get the policy that I wanted.
That was Governor Stephen Meyer weighing in on the Federal Reserve, looking for some pretty aggressive action this year. Cuts of more than 100 basis points. What was it, 150?
150.
150, and still does not know his future on the committee because there's no decision about the future of the Federal Reserve, which is bonkers.
Yeah, he doesn't have personnel control decisions, and neither does anybody else except for one man who has not made the announcement yet, so we are all left wondering.
Not in his forecast, he told us when we asked him about his future. So we count you down to the cash open, about 42 minutes away. Equity futures look like this. We're down about 0.1% on the S&P. We need to get you some morning movers out there as well, so let's do that with Yahara Anand. Hey, Yahara.
Hi, John. If you're a defense company CEO, you've had quite the 24 hours. All these stocks sank yesterday after President Trump said that he was calling for a cap on executive pay, dividends, unless the companies ramped up their production capabilities. But the mood has shifted after yesterday. Later in the day, he said that he was upping the U.S. defense budget, wanting to get it to $1.5 trillion. So as a result, RTX Corp up 3%, Lockheed Martin up 6%, Northrop Grumman also up on that news. Meanwhile, Chevron shares are up nearly 0.7% this morning, and this is on several reports that it is in talks with the government to expand its license to operate in Venezuela. Reuters is reporting that this would allow the company to increase crude exports both to its own U.S. refineries, but also to other buyers. And we end on the fancy members-only club Soho House. Shares are sinking down nearly 10% due to a hiccup in its take-private deal. Apparently, one of its investors now says that it can't pony up a $200 million commitment. So Soho House is scrambling to find other alternative funding. But for now, the vote for the merger to take it private is still on for tomorrow. And you can still apply for a membership at Soho House, which will run you about $3,200 a year here in New York City. John.
Thanks for the update, Yahara. Thank you. It just never kind of worked for me, the idea that you had a private members club becoming a public company, because then all kind of things were going to go wrong.
Well,
just does not work.
You mean exclusivity? The idea that we sort of
completely.
are commoditizing exclusivity and suddenly it's no longer exclusive?
It's like one everywhere now, and
Yeah, they just opened one in Ibiza, and they're opening up one in upstate New York. I'm
there you
excited
go.
about.
You would know. This
They're
is
moving into some wellness. I actually don't have a Soho House membership because I didn't need to, because I feel like it wasn't that exclusive.
Not exclusive enough for you. Yes.
Everyone had it, and also,
Yes.
I was a 5 Hartford Street member. Come
This
on.
is so on brand.
Let's be honest.
I'm in a club of one.
Okay, all right. Good to know. Got no social life. This is it.
That's what I'm saying.
This is it.
This is my social interaction for the day.
This is it. I speak to you guys.
That's pretty much how I am.
You know. So we count you down to the opening bell. Here's the trading time for the week ahead. At 5:30 Eastern Time, President Donald Trump holding a policy meeting Friday. We're going to have the December payrolls report, then UMich sentiment numbers too. Plus, of course, keep note of this, the Supreme Court announcing its first decisions of the year. Looking ahead to next week's CPI data, earnings season kicking off with JP Morgan and Delta. Things really starting to ramp up over the next week or so. Let's stick with the earnings. Vinod Krishna of Barclays writing, while we do think that current street estimates for the next 12 months are overly optimistic, we still expect the S&P to print double-digit EPS growth this year. Vinod joins us now for more. Vinod, good morning. Good to see you.
Good morning.
I'm pleased you've talked about the CPS story, because I mentioned this earlier this week to start the year. If you went off the headlines, you'd think so much of the last year was just about multiples growing and had nothing to do with earnings. But earnings have been pretty decent. You expect more to come. Why?
Yeah, actually, interestingly, we are not the beneficiaries of the base effect. In other words, it's not as if we had poor earnings and hence you have a low bar to beat. Earnings for next year or 25 should be in the $275 range, which means double digits versus the previous year. And we are once again forecasting about 11% growth, which is a tad lower than where the consensus is. But I think the story is more or less the same. When we break up the market and see where it's coming from, the bulk of it is coming from big tech and tech, which we think outperforms expectations. And the rest of the S&P, which is call it 55% of the market, that will be modestly up, but will underperform compared to where the consensus is. But we'll end up with roughly 11% earnings growth, which is the same story as last year.
So do you reject the broadening out trade that so many people think this year will be the year?
We have rejected that for almost 3 years now. If you recollect, that has been pitched over and over and over again. Now, I do think that we are making incremental progress, but the term is incremental. Because even if you look at where it is broadly tech and tech-related beneficiaries, right, which revolve around AI, for example. So that's the reason why, on one hand, we like utilities and the broader tech, including big tech. And on the other hand, it's financials, which are benefiting from a pickup in capital markets. So I have a tough time seeing meaningful broadening in the U.S. equity markets, even this year.
There was a theory that in order for big tech to keep performing, you had to see the rest of the universe start to see the benefits of some of the artificial intelligence, the broadening out in that. Why do you think that 2026 isn't the year where we need to see that?
Because on one hand, if you look at, let's say, the consumer space, right, sentiment is still low, and both for staples and discretionary, we're not out of the woods yet in terms of, for example, staples. They don't have pricing power. They still are facing cost constraints. There's still uncertainty about the trickle-down effects of tariffs, which will slowly and steadily still show up in pockets. So I don't think, and if you look at big tech, their core businesses continue to be so strong and so healthy. And that is what has been driving all the cash flows and earnings growth, which has been beating consensus by almost 8 to 10 percentage points quarter after quarter. So I don't think that in the near term gets disrupted. But to your point, though, AI is getting adopted slowly and steadily. But the biggest beneficiaries of adoption are the tech industry itself. When your software stack is better by 40%, you're benefiting. When your ad optimization is killing it, you're benefiting, right? But enterprise usage is still relatively low, and that will spread with applications being developed. That is a 3 to 5 year phenomenon, and there'll be disruption and new business models, and all that will happen. So as we wait for that process to unfold, the companies which are driving it are the single biggest beneficiaries, and that, by the way, is a trend we have observed over the last 30 years in the 5th tech cycle in America right now. The biggest beneficiaries of technology change is the tech sector itself.
John brought this up earlier. When it comes to AI and your outperform on this trade, how much is that really going to be dedicated on OpenAI having a good fundraising round? Everyone seems to be talking about this IPO.
It's an interesting question. I don't think the big tech is dependent on OpenAI per se.
But the idea of a bubble or not.
But you bring a very valid point, because OpenAI at $500 billion valuation, the last funding, has become a central player in how this narrative will evolve. So to the extent that OpenAI falters in what they are expected to deliver in the next 2 years, then I think the AI theme itself will moderate, and that has the potential to pull down everything starting from big tech in terms of where we are right now. So I think OpenAI does remain central, even though it's a private player right now, given their involvement in multiple angles. But at the same time, look at how the narrative has changed. 6 to 8, 9 months ago, everybody wrote off Google because they thought OpenAI is going to take over the search business. What has happened now? The tables have turned. Now the concern is about more OpenAI, whether they'll get the funding, can they grow their revenue streams, can they have a truly broad business model and such.
Venu, lots to think about, and a good start to 2026 with you, sir. Looking forward to more of the same. Thanks for dropping by.
Thank you.
Thank you, sir. Happy New Year. Venu Krishna of Barclays. Tomorrow's the last day of that.
I knew that you were going to say that. I knew it.
Then we're done.
Came out.
We're already over the Larry David statute of limitations.
I
think it's 3 days.
That's aggressive.
I think 7.
December 15th.
We're already over it.
3 days aggressive. All right. Payroll's Friday tomorrow morning. Looking forward to that. Steve Major of Tradition's going to join us. Priya Misra of JP Morgan. Mike Collins of PGIM. Plus Jeff Rosenberg of BlackRock.